inflation. There are all sorts of reasons for the laggards to catch up, and yet everyone was just investing in a few names, and that worked out very well. You picked the laggards, and you did really well in there. Commercial real estate did well, regional banks, Russell 2000 outperformed well. And right now, I just don't see that. There's just no, we have a good story here. The economy seems to be doing well. The data, while mixed, still seems to be showing strong enough, and yet we can't catch a bid to anything else. And I think the one thing you pointed out, money is flowing into the U.S., but it doesn't even have to go into 7 stocks, right? If you just put it into an index fund, right? If you put it into the NASDAQ 100, about 40% of that money gets allocated to 8 or 9 stocks. So I think most of the money is not coming in directly to those stocks. I think a lot is coming into indices or ETFs or even to some degree mutual funds. I think that's very unpopular. But to the extent it's getting invested in those, it all gets funneled into these same 7 or 8 stocks. So I think that's what passive is doing to us right now. It's forcing all this money into these relatively narrow things that have a good story. And on the factor side, you have momentum. Momentum's been working phenomenally well. It's probably been the one trade that's consistently worked. And unfortunately, or for better or for worse, those same stocks form momentum. So everything's piling into that no matter how you look at it.
Well, and I hate to use the B word, but when does this become a bubble or a problem or something that becomes a note of fragility rather than just something logical based on how much money they're making?
For me, I've been questioning the valuation. We've been bearish from time to time, not pounding the table like this is overvalued or bubblish or anything. But I'd say last week I started getting comments, even from people who own these stocks, who have been big believers. They're looking at some numbers and saying, I have no idea why this is up this much. And so I think that's something to watch. More and more people do, I think, are trying to figure out what's going on with the options market, because that's the other part of this. I think it's daily options, weekly options, whether it's on the ETFs, these weekly single stocks. That, I think, is driving a lot of the activity. That's why you're getting these 10%, 14, 15% moves. You get stops out.
And that's something that I think has been really overlooked with NVIDIA. In their stock split, not only did it make it easier for everyday investors just to buy the cash stock itself, but all of a sudden it's so much easier to trade options on NVIDIA too. It is cheaper to do so. So if we're in a world where more options are being traded, there's more passive money, the quants have all gone momentum, there's nothing else that works. Are you in the David Einhorn camp that something is broken about this market?
Yeah, again, I think passive's taken too much of a role. You have, I think, the options, the need for this daily trading of options. I think, again, a lot of these things, I think what it's going to do is suppress vol on a day-to-day basis because so many people are selling it for income, and then you're going to get these huge gaps. So if the world's kind of a zero-sum game and people are winning more and more, but smaller and smaller amounts, when you get the loss, it's going to be bigger. So I think you want that downside protection because I think we are susceptible to these large, quick, 4 to 7% moves in a period of a week. We may continue to grind higher, but yeah, if something feels broken. The other thing, I think we mentioned it before, but NVDL, it's a 2 times leveraged stock on a single stock. I don't understand why we proved an ETF that gives 2 times leverage on something that's very volatile like that. You actually have this, even if it goes unchanged, but you get this movement, the investors in that will lose money. And if you can't afford to have a margin account, why do you need to play a single stock double leverage? So I think we've made mistakes like that in terms of the products we've allowed to go through, and it's problematic. And it's one reason I think so many people are questioning this market.
Take me to the inevitable outcome of that. Is it Volmageddon 2.0?
I don't think it's anything that crazy. I think there's money there. There's real stories behind these companies. It's not like maybe when we saw 2020, 2021, where stocks were just going up every day. They had no earnings. There was nothing. These are real stories. AI is growing. I think things have got ahead of itself. The story you pointed out earlier, in my own experiences, you try and use it, and by the end, sometimes it's great, and then by the end, you've fact-checked a few things, you've done enough. I'm like, I could have done this myself almost as quickly and learn something. That's the problem, right? As you rely on AI, I think, what do you actually learn, and how do you come at your next approach? And so that, to me, is one of the concerns. So I think there's this AI, everyone has to talk about it. A lot of it's, I think, just simple programming. It's not AI. Some things seem like they should be obvious. It's going to get there. I think the market's got ahead of itself, and last week was the first time I had kind of the real bulls even seem to question. So that, to me, is an interesting change.
Let's talk about the geopolitics of this, because you wrote in your note that you have not been paying a lot of attention to European politics, but now it is actually high on your list. And you're very attuned to geopolitical and political risks. You have generals on your board. What makes you so nervous about Europe?
We've often seen these trends develop in in regions where something starts and then a couple of years later something else happens. We had Brexit, right? And you look at some of the things that triggered Brexit, whether it was immigration amongst them, right? None of that's been addressed in Europe, and now that's what you're hearing in France. You're hearing these countries talk about that. My view is in an economic slowdown, which we could be seeing a little bit of, that's when also people turn more nationalistic, right? It's always great to point your finger at someone else and say, hey, your fault. So this kind of came off my radar screen, and guess what caught me most by surprise is it feels that, certainly in France, it's the extreme left and right are both gaining momentum. And I think a lot of us have been frustrated in the US somehow that it seems that the fringe elements get all the attention, and that's what drives a lot of policy, is catering to those fringe elements. I didn't see that developing in Europe. I haven't been paying close attention, so we have that. And then I think beyond that, you see all our enemies, I think, looking, or adversaries saying, where is the U.S. stand in this? Where's the weakness? Will NATO hold together? I think you're seeing things broadly. This is the first time in 24 years we sent a note yesterday that Putin's gone to North Korea, right? That is a reasonably big change. When we mention China, everything first goes to Taiwan. Well, there's the second Thomas Shoal in the Philippines. That's getting sketchier. So I think people are looking to take advantage of this, and the political discourse is getting worse globally in the West.
I guess the flip side of Putin going to North Korea is because he's so isolated everywhere else, he has no choice but look to North Korea, which doesn't have the best of stockpiles, but yes, they are supplying him weapons. When you look at Asia, when you look at Robert O'Brien is saying in Foreign Policy magazine, what do you make of that? He's calling for a complete decouple with China.
I think that's the direction we're headed. It's, when we talk to our most plugged-in advisories, board members, there's no way we are going to do anything on AI, high tech with China. There's just no way that's coming back. I think that's now viewed as extreme national security. You take a step below that even, and more and more biotech, all the pharmaceuticals, all the other things we've relied on from there. I think people are saying, whoa, what is this going on? I think we're in this awkward position, it seems, on solar panels where we want to go green. Somehow we ceded the solar industry to China, and now we're putting tariffs on Chinese solar, and it kind of makes your head hurt. So I think this is all going to separate, and people are really going to do more and more on their own, realizing that at a high level there's independence. And I think, unfortunately, China's quite fine with that, right? They are building this network of what we refer to as the autocratic, resource-rich nations, right? China does very well with the autocrats relative to us because we have principles. We have things that we want these countries to do and behavior that we find acceptable. I think China doesn't really care so long as they have a trade relationship. So they've accumulated this network of autocratic, resource-rich nations, which includes some bad actors, right? It includes Iran, it includes Russia. I think that's problematic.
So put this together, because you're talking about sort of the narrowness of the rally in the United States, the potential for political risk that a lot of people are not focused on or hasn't been priced in. What do you think is most vulnerable to a repricing as political risk becomes more prevalent in people's minds?
I think it's going to be some of this big AI spend. I think people, if we see a slowdown in spending at the consumer level, I think we see some of that. If the jobs numbers start reflecting what we saw in the household, not the establishment survey, there's going to be some concerns. Where's this economy headed? I think we're going to see a little bit less travel this summer than we did last summer. All these things are slowing. I think that will decrease spending, and then people will question, what are these valuations? And I do think we're very susceptible to some sort of a commodity shock over the summer, where on the good side, I think for a global economy, it would be India continues to grow. And, they had some hiccups after the election, but India's been on a good trajectory. They are demanding more and more commodities. China's going to do more and more. And then we have these enemies who all control commodities and don't necessarily like us. It just feels it's very susceptible as we're in the heat of the election that someone pushes our buttons.
So it doesn't sound like you're particularly bullish right now.
I'm not particularly bullish. And again, like I said, last year I loved the laggards and I thought they could catch up, and they did. I just don't see how the laggards really catch up in this market unless it's in a down market where the valuations come down on those high flyers, momentum breaks. And we've seen that so much. It reminds me a lot, in treasury trading, where I think the commodity CTA advisors really drive a lot of it. And you see people like, why does it keep going up? Why do yields keep going up? Went to 5%. Boom, 420, 460, 410. And so you see these momentum trades get stopped out. I think it's been a very difficult year for a lot of momentum away from AI. Treasuries have been mean reverting. I think that comes down, it breaks in AI, and that's that last refuge in momentum. And that's why we would get the severe 5 to 10% pullback in a very short time again.
Peter Scheer, always wonderful to see you. Don't be a stranger. Peter Scheer of Academy Securities. Have a great time on your vacation. Let's get you an update now on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackness. Yahira.
Hi, Lisa. Apple is shutting down its Pay Later program after launching it just a year ago. The program allowed users to pay off purchases of as much as $1,000 over 4 installments. The move marking a retreat from Apple to offer more financial services in-house. The iPhone maker recently announced that third-party services, such as ones offered by Affirm and Citigroup, would be integrated into its upcoming iOS 18 software. Fisker has filed for bankruptcy, the announcement coming after the struggling EV maker held discussions with a major automaker about an investment, but failed to secure a deal. Fisker listed assets of between $500 million and $1 billion and liabilities of between $100 million and $500 million in its bankruptcy petition. The filing protects Fisker from creditors while it works out a plan to repay them. And NFL Commissioner Roger Goodell rejecting claims the league colluded with DirecTV to set the price of the Sunday ticket broadcast package. The NFL is facing a lawsuit from fans that want to revise its broadcast policies to allow for greater access to the games at lower prices. The NFL could have to pay as much as $21 billion if it loses the trial because damages can be tripled under federal antitrust law. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, New York crude holding above $80 a barrel as we head into the summer.
We still think the summer is going to be good. We think inventories are going to draw, so the crude market is going to be supported. But certainly there is that element of potentially moving into an oversupplied market.
That's coming up next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Coming into Tuesday of a shortened week, retail sales Tuesday as markets maybe try for a 31st record high to close the day in terms of the S&P for 2024, losing some of that steam right now, basically flat, 55.45. You could see that euro weakness just continuing, 107.16. 10-year yields up just marginally in crude. Want to sit on crude for a second, up just a touch, $80.37. A gallon traded on the NYMEX yesterday, up 2.4% as people took a look at possibly more demand as well as potentially more disruption. Under surveillance this morning, New York crude holding well above $80 as we head into summer.
We still think the summer is going to be good. We think inventories are going to draw, so the crude market is going to be supported. But certainly there is that element of potentially moving into an oversupplied market. We are in a world where there's commodities that are very sensitive to prices on the supply side and commodities that are not. And that's kind of the balance we're seeing.
Here's the latest. Oil basically flat today after hitting its highest level since late May, driven by a risk on sentiment in global markets. This comes as parts of the U.S. are bracing for a heat wave expected to bring record temperatures. Joining us now, Bloomberg's Will Kennedy. Will, can you just give us a sense of what you're hearing from people in terms of the momentum that we've seen over the past few weeks, in particular last week, when it comes to higher oil prices and whether people think it's sustainable?
it's been a strong market, and you can really see that if you look at the price for oil in the near future and oil slightly further out. Those spreads have rallied to the highest since April, which shows there's a strong call on oil right now, that inventories are drawing down. And I think people, as Francisco was saying a moment ago, always expected this. We're moving into the peak months for demand, the so-called driving season. People are moving around the US, they're moving around elsewhere, they're flying, and that demand is expected to draw down and is drawing down inventories globally. So we're hitting a strong period, and I think that's reflected in the flat price of crude, which has come back quite markedly. But as Francisco said, there may be less certainty ahead as we get through this period into the latter part of the year.
This is sort of the reason why maybe you're not seeing that lift follow through in the gasoline market in the United States. Actually, you've seen declines there to $3.45 a gallon from as high recently as $3.68 back in April. I'm just wondering the significance of that. I mean, this is basically poised to shift, to inflect higher. Is it completely divorced at this point based on refineries and supplies of oil and where it's coming from versus the global market?
Well, one of the things we've seen globally is that refining margins, the profit that people get from turning crude oil into gasoline and diesel and jet fuel, have come off. US refineries are still working very hard, as you would expect, going to the driving season. But in other parts of the world, we've seen some spare capacity in China, for example. Margins are not strong, and I think that's reflected and followed through into the global fuel market, and that's why you haven't seen gasoline prices react in the same way that we've seen crude prices react in the last few weeks.
But what you're saying, Will, is that we're seeing stockpiles move to drawdowns. We're seeing potentially we're going to have a driving season that's going to be big and robust. On top of that, we haven't even seen hurricane season just yet. What potentially could we see trickle down into the oil market into gasoline prices?
I think the hurricane point is very well made, Anne-Marie. We haven't seen any big hurricanes the last few years, but all the indications point to the fact that we could see some very big storms in the Gulf of Mexico, and that can often have a big impact on markets in two ways. It can shut oil-producing fields on platforms in the Gulf of Mexico, and it can hit those giant refineries on the Gulf Coast in Louisiana and Texas that are so vital to supplying gasoline to the US market. So that clearly is an extra risk going through the summer months, and one reason why people may not want to be caught short in this market.
Well, is the U.S. well-positioned, should that risk come to fruition, to withdraw from the SPR after already having done so, after not having filled it up? If we get to those risks, can the U.S. mitigate them?
Well, the current administration has shown itself very willing to pull that lever. There's not as much oil as there was in the SPR, but I think there was an interview by the Financial Times with Amos Hochstein of the administration earlier this week, where he said that the administration would be willing to pull that lever in the months ahead, that their priority is to keep gasoline prices low for consumers, especially running into the election in November. So I don't think you can rule it out, Danny, but there is a lot of resilience in the US system before you get there, and I think it would have to be a very severe disruption before that happened. But at the end of the day, that's what it's there for. It's a strategic reserve to smooth out disruptions in the market, and if you've got a very strong hurricane, which took a lot of oil offline or a lot of refining capacity offline, and we saw prices spike, that option is clearly there.
That's on the gasoline side of things. Well, I do wonder what you think about natural gas and some of the other utilities costs just generally as we do head into a hot spell. A lot of people say it's always hot, it's summer, but this is a particularly hot spell. We're talking about record highs across the Midwest, headed to New York City. Today, it should start. We're all very excited. Well, do you have a sense of how this will sort of show up in energy markets more broadly, and frankly for consumer bills that have clearly factored into how much money they have left over for retail sales, which we get in about an hour time?
One of the trends we've seen globally in energy over the last few years is that this difference between demand in the summer and the winter has lessened, because obviously heating demand in the winter has come off a little bit as well as get warmer, but demand in the summer has gone up because people are just having to run their air conditioning units harder and harder. And we'll see that as we go into this heat wave. That will produce a draw on natural gas. I mean, the US Northeast generates energy in lots of ways, but natural gas is one of them, all down the east coast of the US. It will draw on natural gas, and we have seen a rally in natural gas prices. They were extremely low in the spring, and people, why there was a glut. We saw some producers curtail production, and then this will drive demand higher, so you will perhaps see those prices continue to come up.
Bloomberg's Will Kennedy, thank you so much for being with us. It's a real question. I mean, every year people have been talking about how hot it gets and then how this will really factor into utility bills. But it's not just gasoline, Emery. It's also the amount that people are paying on their monthly bills that really does crimp their ability to spend elsewhere.
Absolutely. For electricity, when you're thinking about this heat wave we're going to see, Manhattan Central Park set to reach 98 degrees Fahrenheit on Friday, according to the National Weather Service. And then that heat is just going to spread. Upstate New York, the Midwest, it's going to be a massive week for a heat wave.
And they have cooling centers, and people are trying to, go to movie theaters, go to the beaches, try to figure out exactly how to toe this line. I mean, it speaks to something Peter Scheer was talking about, though, and to your point, Anne-Marie, about a possible disruption. How far away are we? How vulnerable are we to an increase, say, $10 a barrel or something like that, to really cause something in a dent?
Well, then the concerning thing he pairs with that is the geopolitics of it all, that these commodities are in large part held by adversaries of the U.S., that India is consuming more. So you put all of these together, do you worry about something more pernicious?
Coming up, we're going to be speaking with Bank of America's Marcy McGregor on why the bullish market will continue regardless of all the fears that we've just been laying out. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Coming into Tuesday with air soaked in uncertainty, the Patrick Harker quote of the morning. Emery will get to that in 1 second. Markets basically don't know what to do with that because how could you basically flatten the S&P? Do we get a 31st record high of the year? Right now we're looking at NASDAQ futures eking out a gain, as that is not a surprise to people given the leadership that we've seen in the Russell 2000. Also not a surprise, down about 0.3%. When you push it through the bond market, this is interesting. And Danny, yesterday I thought it was interesting. The sell-off that we saw that was paired with issuance of corporate debt. This idea that people sold treasuries to go into some of the corporate issuance that was happening pretty much across the board.
Part of the reason I think it's also interesting is last week was so quiet for corporate issuance, and there's this feeling that we're getting a lot of rate volatility, things are uncertain, so corporates are starting to pull back. Well, yesterday proved us that that was all wrong, that there is still this huge demand, not just to issue bonds, but to also absorb them, hence the sell-off. So things all fine and dandy for corporates, even though we don't know what the cuts will be, we don't know what the data will be, and we're all confused.
Which is the reason why, Anne-Marie, air soaked in uncertainty.
As he was placing his dot at last week's FOMC meeting, and kudos to Andrew Hollenhorst for pulling out the most interesting color from that speech, basically what he said is that if all happens to be forecasted, I think one rate cut would be appropriate by year's end. Indeed, I see 2 cuts or none for this year as quite possible if the data breaks one way or another, which is why people are so data obsessed, because the Fed is data obsessed, and which is why I'm excited for retail sales.
Yeah, although then people will explain why we should or shouldn't care about it. So the air soaked in uncertainty ends up continuing that way. Which you can see euro a little bit weaker versus the dollar, under surveillance this morning. More trouble ahead for Boeing. A new whistleblower alleging the plane maker mishandled and lost track of hundreds of faulty parts that may have ended up in new 737 MAX jets. I tripped over myself because I have to admit, Danny, I hate this story. I hate talking about all the problems with Boeing planes. I hate talking about the idea of faulty parts going into planes that we fly. And I just wonder what structurally has gone wrong where there are these whistleblowers that still have what to say that hasn't been heard already.
And it's remarkable that this has been going on for how long? I mean, even before the Alaska air door incident, we knew that there were problems with Boeing, and it is uncomfortable. It's uncomfortable every time you have to get on a plane and you look at the little thing on the seat behind you and say, oh, 100%. I'm gonna be honest, I do that, and then I put an eye mask on and try to go to sleep and not think about it.
Well, that's right. I mean, do you look and see, and then you just basically decide not to fly, or you fly?
I did on my most recent flight. I happened to see that I was flying on Boeing. I had a moment of a thought, and then I put my earphones in, and I just said, well, I have to get home.
Yeah.
What struck me about this story is that what these non-conforming parts are, they're damaged or inadequate components. They're supposed to be tracked, disposed, or repaired, and meticulously recorded. None of that seemed to be happening. And what I have a question for, and I'm sure a lot of senators today, when they skewer the CEO, are going to have questions about, is if this is what we are starting to know, what is still happening under the hood that we still don't know about? What more whistleblower reports are going to be expected?
And I also want to understand exactly what the casualties are of the pandemic era, where a lot of people retired who had institutional experience, where you had people who weren't paid as much as inflation was increasing, and you had a real shift in terms of the population of workers. How do you change that? And that's one of the reasons why maybe people don't want to get in and be the CEO.
I find this so remarkable, the Journal reporting that some of the lead candidates for this, like Larry Culp of GE, don't want the job. But you need to have a really coherent thing of how you fix this beast, because it is a beast of a company. It's huge. I remember Calhoun told Guy Johnson, essentially just saying, we need to stay disciplined. I mean, that's not enough. That doesn't make me feel safe in a Boeing just to hear the CEO saying, we need to stay disciplined, because what, you weren't before?
It should make you feel safe that we are in air-soaked in uncertainty. I'm talking about Philadelphia Fed President Patrick Harker, who's seeing one rate cut this year. Harker saying that he's looking for several more months of improving inflation, plenty more Fed speak coming today. As investors await retail sales data out in an hour's time, you do wonder the relevance of some of the commentary, considering that they don't really have much confidence. Air-soaked in uncertainty, key example. Nonetheless, Anne-Marie, it's interesting that the rhetoric shows it wasn't an aberration. that the Fed coalesced around one rate cut this year. It was definitely some kind of lack of conviction that was even in some people who had been previously somewhat dovish.
Absolutely. That's why this is so interesting, because it does feel like they have this lack of conviction. And everyone who's saying, well, when that inflation print hit just before, potentially this is going to give some of that support the Fed may mean to want to say, okay, we see the soft landing, we are going to start to potentially make a cut. And they actually came out more hawkish and said it's not going to happen until December. It feels like the whole FOMC moved more towards the Neil Kashkaris.
Which I find, which is interesting because it's coming at a moment where people don't care. And basically people all shrug this off and they are unabashedly optimistic, at least about stock market returns. The latest Bank of America Fund Manager survey found that investors are now the most bullish since November 2021 and are likely to keep pumping money into record-breaking stock markets. Marcy McGregor of Merrill and Bank of America Private Bank writing this: we see catalysts for the bullish trend in markets to continue. We view any pullbacks as a buying opportunity. We anticipate markets to feel choppy in the coming months as markets may take a breather. A lot to digest there, Marcy, joining us now. And just want to say, Marcy, so good to see you. Thank you for being with us. We know that you're not responsible for the Fund Manager survey, but you do help to understand and interpret it for the clients that you advise that oversee something like $3.8 trillion in client balances. So not a small pool of cash. How do you have the conviction to be bullish at a time where there are so many people who feel like this is getting narrower and narrower, with the most crowded trade being the Magnificent Seven?
Well, thanks for having me. Of course, we want to see this market broaden out. And there's reason to think that the market may feel choppy over the summer, especially as we enter election season and the Fed is battling this last mile of inflation that's giving them a bit of a headache. But when I think about the ingredients for the overall bull trend to continue, we have a lot of liquidity in markets. Financial conditions are easy. We have a solid earnings backdrop that we think will broaden. If you look at this market, so far the S&P year to date has been driven by earnings, not multiple expansion. So that gives me confidence. Also, we're seeing bond yields. I think they'll stay pretty range bound, but they've been making lower lows and lower highs. I think that's a positive for equity markets. And then finally, we can't discount the innovation that's pervasive in the economy right now around artificial intelligence. So I think the bull trend continues. It may feel choppy. We may get a pause here in these early summer months. And what we've been saying to clients is this bull may turn into a buffalo and start to roam a little more, but I think the uptrend is intact.
Well, whether it's a bull, whether it's a buffalo, whether it's a cow, Marcy, what we see is an air of uncertainty, and that's what we were talking about with Patrick Harker, this issue that Fed officials themselves don't know how to read what animal that we're looking at. And so it raises this question of where do investors get the conviction that they understand at a time where people are still debating whether 10-year Treasury yields, as we had earlier from Lara Ream, of FS Investments going to 5%, or are they going to 3.5%, like what we heard from HSBC's Stephen Major? Marcy, how important is that to you, given the bifurcated calls that we're hearing all across Wall Street?
Well, in the near term, I think the path of least resistance for rates is probably lower. But when I take a step back and look at the economy, our view is that the economy is moderating, but very slowly. And I think that'll be music to the Fed's ears. If you see, we've seen pockets of the economy like, retail sales, like housing, like manufacturing data showing some slowing. And then we have a really strong labor market that I think under the hood is normalizing a bit. But it's still pretty strong, giving a tailwind to the consumer. The bottom line with the economy, though, is it's hard for me to get overly bearish when there's so much fiscal support that's creating quite a cushion for this economy. So while I think the economy is going to moderate slowly, it's going to allow inflation to start to trend lower. But I think at the end of the day, we may have a higher resting heartbeat for inflation for some time. So inflation that stays somewhere above 2%. But a Fed ultimately that gets the confidence to cut this year, the Bank of America view is one cut in December. I do think there is a risk based on data that, that could be two. But ultimately, I think you're going to have a Fed that keeps telling us to be patient. They need a couple more inflation prints before they gain the confidence to cut. But when the Fed's data dependent, the market hangs on every data point. Once we get into the next earnings season, though, I think the confidence will come back to investors with this bull market trend to continue.
Marcy, it does feel like unbridled optimism for earnings, though, especially if it is a slowly moderating economy. For next year, for 2025, the estimate for earnings growth is 14%. That would be the best year, if you exclude the COVID weirdsies of 2021, since 2018. Does that sound right to you, 14% earnings growth for next year?
I think that's a little bit optimistic. I think you're going to see that revised lower. But the key here, I think, is earnings broadening. So the other 493 companies starting to really pick up. Now, we're seeing early signs of sectors and industries starting to join the party that's really been, of course, led by tech and the Magnificent Seven. I also think it's going to be important to the earnings story that you get small caps in the party. I think we may see an inflection point here where small caps start to show a little more green shoots on the earnings front as we look ahead to 2025, and may even start to outpace their large cap peers. So the broadening story, I think, is going to be really, really important to reach any of these optimistic earnings estimates. But I would expect, I think that for the consensus is a little higher now for 2025. So I could see that coming down a bit, but broadening is going to be key here.
Potentially, we will see that broadening out then, Marcy. You mentioned two things. One, uncertainty around the U.S. upcoming election. Also, you meant the fiscal support we've seen out of the United States. Do you see any sign of that abating?
You know, what we typically see in a classic presidential election year is the VIX spikes by about 25% from July to November. So that choppiness isn't going to surprise me. And of course, volatility is at really low levels already. But once the election is past us, I think markets return to fundamentals, which do include policy. A lot of this spending has a bit of a lag to it. You know, when we think about the defense spending that's been earmarked for this red hot geopolitical world that we're in, a lot of those dollars get put to work in the U.S. If we think about the infrastructure spending from a couple of years ago, that is more of a medium-term support to the economy. So it wasn't all put in the ground right away. You know, I think ultimately that's going to support construction, transports, machinery, investments kind of in the old economy as well as in a green economy. So I think there's some legs to this. It's hard to see right now any will in Washington to turn the fiscal faucet off. So I think there's a chance it could continue.
How much are you concerned about what we're seeing in terms of the fiscal overhang, the deficit? And we've been talking about this. We were just talking about it with the New York City head of the investments for public workers. He's concerned about it. He sees the sizes of auctions going up as significant. He thinks that at some point you could see pushback in markets akin to what we've seen in Europe. Is that something that you see on the horizon or that you're advising clients to be aware of as they come up with the new 60-40, whatever it may be?
This is the number one question I get at client events is concerns around the debt and deficit. And I do think my main concern with it is that it could dampen future growth. It could be stealing from the future. It could drag on growth. It could drag on future spending. But when I think about it as an imminent issue, our colleagues at Bank of America Global Research did some fantastic work on this and found the weighted average coupon of the national debt right now is about 2.25%. As long as that stays under nominal GDP, and of course that's well under nominal GDP right now, we don't expect that to change, that would be the inflection point where we would start to get more concerned. So we have a bit of room there, even though the overall picture of the growing debt is a bit concerning. Realistically, I think my concern is that this could borrow a bit from the future, could put a bit of pressure on the private sector to boost the economy going forward. But ultimately, I'm not concerned that we're at a tipping point right now.
Well, this is the thing, right, Marcy? It's fine to spend, but it matters what type of spending and how much growth you get from that spending. We hear the language coming out of France and deficits there, that the type of spending that they're doing can reignite the economy and make up for it. When you look at a global picture, Marcy, are we in an over-leveraged world, and can growth keep up with the type of deficits that countries are running?
Well, in the post-COVID world, clearly the gorging of spending has been happening on the government level. We're not seeing it in corporates. We're not really seeing it on the consumer balance sheet, which we're still seeing is really healthy. In fact, our internal data is telling us that deposit balances are still about 40% above 2019 levels. So we didn't see the excess on the corporate or consumer side. We did see it on the government side. So it's something we need to watch closely. I think it's a risk. It's a risk risk, again, in terms of going forward, will Washington have the will to spend? And you're absolutely right. You want to see government spending on areas that can add productivity to an economy, and that does not include interest income. So what the government spends on, anywhere in the world matters. We did see some of this spending go to areas that could add to productivity around research and development, infrastructure spending. Those are all areas that I think could boost the overall productivity of the economy. Interest income, like I said, is not one of them. We're not at that tipping point just yet. Clearly yields coming down will be music to the Treasury's ears.
Marcy McGregor of Merrill and Bank of America Private Bank, thank you so much for being with us. Great to hear from you. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with the one and only Yahira Hackes. Yahira.
Hi, Lisa. Get the Geek Squad ready. Best Buy is preparing for one of its biggest product launches of the year, AI computers. The retailer is said to be training more than 30,000 employees to sell and repair PCs equipped with Microsoft's new Copilot AI, which go on sale today. Best Buy says it has exclusive rights to more than 40% of Copilot PC models. Bitcoin touched a one-month low in early trading. The cryptocurrency is being weighed down by the prospect of higher for longer U.S. rates and outflows from digital asset investment products. It fell as much as 2.7% this morning, touching levels not seen since mid-May. Smaller tokens, including Ether and Solana, were lower as well. And the Boston Celtics are back on top. The Celtics beat the Dallas Mavericks in the NBA Finals, led by their star duo Jason Tatum and Jaylen Brown, taking the series in 5 games in front of the home crowd. It's the franchise's first title since 2008. And the Celtics have now passed their arch rivals, the Los Angeles Lakers, for the most titles in NBA history. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Steve Pagliuca, just want to tell you, you're winning life, and every day we are reminded of it because the Celtics, his team, and it's just yet another of his
his
portfolio.
football team as well in Italy, Atalanta, plus the Celtics. I mean, who's having a better year than Steve?
Well, come on and make us all jealous of you, Steve. Up next, the Ozempic effect.
The AI theme has been applied, and it's almost turned into a macro story, right? That this is going to create, higher productivity in workers, and you're going to get a GDP growth that is higher than you might have assumed. GLP-1, which we've talked about, also kind of fall in that category.
That's coming up next. This is Bloomberg.
Names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
Especially I'm afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
We're still talking about the Celtics right now as markets search for direction after 30 record highs in 2024, led by big tech. Meanwhile, what we see is a lot of questions about when that will shift, including potentially some of the other trends other than, for example, AI, like Ozempic. Under surveillance this morning, the Ozempic effect.
The AI theme has been applied, and it's almost turned into a macro story, right? That this is going to create, higher productivity in workers, and you're going to get a GDP growth that is higher than you might have assumed. GLP-1, which we've talked about, also kind of fall in that category. So yeah, I mean, there are some big assumptions being made. What does this do to kind of longer-term trend economic growth, and what does that do to your kind of long-term view?
Here's the latest. The GLP-1 revolution playing out in retail. The Wall Street Journal reporting customers are downsizing on clothes and renting the smallest sizes in 15 years. Sucharita Kodali of Forrester Research joins us now with retail sales just over 30 minutes away. Sucharita, let's talk about this. I read this story and I thought to myself, is this really true? Can we really attribute people looking for close-fitting types of dress wear, et cetera, to the Ozempic effect? Do you see this as truly having legs and actually shifting retail sales going forward?
Yeah, when you looked at the story, even the data that they cited said that it wasn't necessarily a clear correlation. It is likely just the fact that people during the pandemic purchased a lot of larger size clothing because they were at home. They may not have been working out as much. They may not have been as physically active. And now they're just back to their regular routines. I think that there were some speculation that Ozempic was the reason, but it was more a correlation, not causation.
Is there something interesting, though, Sucharita, about the numbers that you've seen in terms of just how much people are going back to retail, how much people are going back to shopping for clothes in a way that a lot of people said that they wouldn't after the pandemic, and frankly, even before that, when people saw a real selectivity and greater discretion among consumers?
Yeah, this entire retail economy post-pandemic has been very, very curious because the retail sales numbers have been at all-time highs. And until the last few months, they've even exceeded inflation, which suggests that the number of units that people are purchasing across categories, not just sectors like apparel, but a lot of essential goods like food categories, consumer packaged goods, the mass merchants were doing particularly well. And it was at odds with this consumer confidence set of numbers, which were entirely down. And that's the reason that we have that expression, the vibe session. People feel one thing, but they're actually doing another. And that's what we're seeing in the economy. Only now, I expect probably the numbers today to have a little bit of softness and they'd probably be at the level of inflation, possibly even less.
Can I ask about social media? I know this question is a little bit out there, but I am a user of the Reels, of the TikToks amongst all the kids. And I feel like I open up my phone every day and I see a new fashion trend that I'm supposed to be latching onto. Like apparently now I'm not allowed to wear ankle socks because it shows that I'm a millennial. Now it seems like the fashion, it's a real thing. Lisa's given me eyes. It's a real thing. It shows that you're a millennial now. Yeah, if you wear low socks, it's clear you're old. Does this show a faster fashion cycle that's getting people to go out and spend more? Is it having any real discernible difference?
That is probably the bigger thing. They're not just the social media, but companies like Shein and Temu, which have sort of come out of nowhere. They've paid a ton of money for online advertising, acquired so many consumers, and they have super, super cheap prices. So they're able to get people to purchase at a faster rate, too. I mean, certainly the lower a price point is, the demand curve is going to have you purchasing more units, and that's absolutely happening. And that's something that is unique and curious about the apparel industry in particular. It's one of the few product categories in consumption where the average price point has actually gone down and has barely kept up with inflation. So that's definitely one of the things that we're seeing is more of these really inexpensive units being purchased and some of these Chinese sellers being the places where we're purchasing.
So, Truda, I was struck by something you mentioned in your note, the fact that Kroger, the U.S. grocery behemoth, is in Cannes, France, the south of France. Why?
Yeah, I thought that was really interesting too. So Con is the big advertising and media industry conference that happens, on the French Riviera every year. And normally you expect the companies like Meta or Google or, flashy advertising agencies and media companies to be there. But Kroger actually has a pretty strong presence there this year. And the reason is because they are trying to pitch their retail media business. Retail media is advertising on a retailer's website, in their properties, and Kroger is trying to get a piece of the advertising pie that Amazon Ads has essentially established for the retail world.
Sucharita Kodalia, Forrester Research, thank you so much. I am now going down a rabbit hole about ankle socks. They've evidently been canceled.
It's a thing.
I'm really upset about this.
No,
Why?
They'll literally make TikToks like filming people on the streets and being like, I can tell if they're a millennial or a Gen Z or a Gen X, depending on what socks they wear.
But it's very specific. It's not about them being canceled. It's about a new fashion where the socks go up to
Crew socks.
mid-calf.
Crew socks.
Yeah, but what's the thinking here?
I guess they're back.
Where did they go? I don't know.
Well, I'm just wondering. There's something about, the sort of clean look of if you wear shoes that have that. Anyway.
I feel like you're getting somewhere, Lisa. I see it working.
I'm just,
It's a heat wave. Why is everyone wearing socks?
I agree with you.
It's sandal season. Just don't wear socks with sandals.
Okay,
that's a
something
rule
else.
everyone agrees with.
That's actually not true. Haven't you seen the Birkenstocks with crew socks?
Good point.
I'm sorry. Anyway, this is quite the fashion discussion. Our sartorial leader evidently is gone out, and we are making it up as we go along. Coming up, David Leibovitz of JP Morgan will save us, not talking about crew socks. Ian Shepardson of Pantheon Macroeconomics and Gregory Dacko of EY, as well as David Rubenstein of the Carlyle Group. Yes, Anne-Marie?
No, nothing. I'm just saying I'm not making it up. Definitely don't wear socks with sandals.
Is that what you're doing? Honestly, let's move on. What we are seeing right now in markets is potentially another day of record highs, although off that, basically range bound. And what I'm seeing right now in yields, marginally up. I'm seeing in crew socks is people telling me to get rid of them all, which is really annoying to me because socks are expensive if you get good ones. And I don't want to throw out ones that I like.
So many low ankle socks, literally, that I will hold up retail sales on my own by buying new socks.
We're going to let this go. We're going to let this go after this. This is Bloomberg.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
This week wants better data. It wants to be assured that the economy really is strong.
The incoming data has been unstable enough that has kind of reflected itself in the instability of the markets.
This is a normal economy. You're not going to make straight A's every quarter. You're going to have some weakness here and there.
Risk assets have just cruised through this whole thing, and they ignore the volatility.
I think in general, looking at this all very holistically, it's really going the way that the Fed would like it.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
30 minutes away from understanding just how many stocks people are buying in order to update their crew stock holdings to something more fashionable, maybe to wear with Crocs or, potentially Birkenstocks like Anne-Marie Hordern. Welcome back. This is Bloomberg Surveillance. She is horrified to think that potentially anyone would catch her dead wearing sandals and socks. We are 30 minutes away, 29 minutes away from retail sales at a time when a lot of people are focused on the narrowness of leadership, and we're not talking about stocks, we're talking about the equity market rally and just how much consumers can keep spending on things other than stocks, but also just their natural expenses that have gotten so much greater.
Yeah, I mean, you had this moment where inflation went from 9% to something more like 4% in the span of a year. Then it bumps around 3 to 4%. So you don't have that real income gain that you once did in the year past. At what point does that finally start to make people feel not just poor, but finally unwilling to go out and spend?
Which has been a huge question mark underpinning, frankly, this vibe session that we keep talking about. At a time when we have a lot of people, the data on Friday, University of Michigan Sentiment Survey coming in much weaker than expected, with some of the underpinnings really highlighting it isn't just inflation. It's also that people are not as confident about their job prospects at a time when we're still seeing record highs.
Right, so they're feeling it on both ends. And I think what we all agreed, what was so interesting about the Michigan report was the director coming out from the survey saying that the middle class, for the first time really in a really long time, historically you don't see this, they're starting to feel like they are part of the lower economic income level. And that is very concerning. I was struck by what Paul Donovan had to say this morning, the chief economist at UBS. He said U.S. retail sales numbers are due and U.S. consumers should continue to spend money they do not have on things they do not need. However, an anecdotal evidence suggests U.S. consumers are more price sensitive and refuse to spend in the face of price increases. And that really, I think, mirrors what we heard on Friday from the Michigan survey.
Which highlights how confusing this moment has been. And you talked about how you're confused. Patrick Harker is confused. Anne-Marie, you pointed to this, that in his comments yesterday, he said that he is surrounded by air soaked in uncertainty. Thank you to Andrew Hollenhorst, the team over at Citi, for highlighting this. But I am wondering, Danny, how much this sort of clouds how the market's going to respond to retail sales that are expected to soften. But it's unclear exactly how to interpret it at a time where some people, like Laura Rame, are telling us, ignore it.
Yeah, I mean, it is a moment in time where it seems like the Fed, their uncertainty, their default is just to do to dots for one, just one cut so far this year. But the market doesn't believe that. The market's been pricing in 2 or 3. That's what the fund manager survey also showed us. It's almost as if the Fed is overcorrecting for what they did in December. That uncertainty played out in them saying, unleashing this verbal cut to the market, of Powell talking about it. Perhaps they're living with those scars and are very concerned about getting excited about the data. So maybe even if they had all the data in hand today, be it the CPI, the PPI, maybe even, who knows, a softer retail sales, maybe they still would have put in one cut.
Yeah, well, this is something that we keep parsing through, and that's why we'll be listening to the 6 Fed speakers that come up today. Right now, in markets, not doing a lot. Session is young. We saw this yesterday, too, kind of waffling around, and then into the close, really rallying. The interesting thing to me is the ongoing outperformance of big tech. You've seen that so far year to date. The S&P's overall gain, 15%, almost that. Equal weighted, 4%. Russell 2000 down again today, down on the year. What we can see is dollar strength on the margins continuing, just because where else are you going to go? The euro 107.16, following some of the political turmoil surrounding France in particular. Yields higher, and we've been watching this with respect to some of the corporate issuance and how much that takes away some of the demand for benchmark U.S. government debt, 429 on the 10-year, and crude kind of bouncing around here after hitting the highest levels going back about a month, $80.28 traded in the NYMEX. Coming up, David Leibovitz of JP Morgan with U.S. equities continuing to break records. How much can you pile in? Ian Shepherdson of Pantheon and Greg Dako of EY with retail sales on deck. Do we get some clarity from all of that? But let us begin with our biggest big story. Mega caps lifting the S&P 500 to its 30th record of the year, with U.S. retail sales data due in about 25 minutes. David Leibovitz of JP Morgan writing this: we take the Fed at their word and believe a rate cut will be delivered by year end. But clearly this decision will be dependent on the evolution of the data. David joins us now. David, does it matter if the Fed cuts rates this year, given the fact that it basically all depends on whether NVIDIA can keep collecting cash and paying out dividends as much as it has?
So I don't know how much it matters that the Fed cuts rates before the end of the year. I think what's more important for the market today is that the Fed maintains an easing bias. You know, if they begin to say, look, the data's not cooperating, we still want to ease at some point down the road, and it looks like that's going to happen more so in 2025, I think the market will take that relatively well. Let's not forget, we went from pricing in 6 rate cuts at the start of this year to now just 1 or 2 rate cuts following the June meeting. And so I think the market recognizes what the Fed is trying to do. I think the market recognizes that the Fed is going to be data dependent. What I think would really spook the market is if you saw a reacceleration in the underlying data and the Fed came out and said, you know what, we may need to do a bit more. I think that is the big risk.
We've been talking about the volatility on the heels of a lot of data prints. And I wonder in 24 minutes time, if we get a really hot retail sales print across the board, not just in some key staples, will that affect things significantly? Will that move the dial in the narrative roulette that we keep playing?
I think that the market is in an interesting spot because we've had this kind of variety of data over the past couple of weeks. You had CPI, which looked very good. You had the most recent jobs report where, let's not forget, we added 300,000 jobs and wage growth actually accelerated. I think what the market wants to see is that the economy is coming back into balance. And so I'm not sure that a hot retail sales print would necessarily be, you know, the cat that gets thrown amongst the pigeons. But if we were to begin to see a series of hotter data prints, I think that's what would cause the market a bit of concern. To your point, the market's kind of hanging on every data point here. You think about that 15 basis point move in the 10-year on the back of the CPI numbers last week. I mean, that level of volatility says to me the market is still viewing the distribution of outcomes as being relatively wide and is looking for that broader trend before it begins to settle itself down.
If we see a broader trend of some normalization, can the rest of the market finally do well? Not just the big tech stocks. Can we finally start buying cyclicals, small caps, literally anything else but tech?
So let's put small caps off to the side for a moment. I think they're a bit of a different animal. We just finished our quarterly strategy summit last week, and one of the themes that came out of the equity sessions was that we really should see this broadening out of earnings growth into the more cyclical parts of the market during the back half of the year. I think the challenge to that view is that we are talking about a softer nominal growth environment, so cyclical is accelerating as nominal growth is slowing. To me, there's a little bit of dissonance there, but I do think when you look at the flow flow of earnings that these companies have had over the past couple of quarters, it does look like they're going to at least pick up relative to what we've seen as of late. Small caps, it's a rate trade at the end of the day. And, we can talk about Russell 2000 versus S&P 600. Obviously, the number of unprofitable companies, higher rates very much weigh on that dynamic. You would also want to see just, I think, more robust real growth, and that's certainly not what's coming through in the data.
For the tech players, for the time being, one of the changes we've seen is the capital intensity that has befallen all of these businesses. Usually they're businesses with really incredible margins, but all of a sudden, they're needing to find themselves spending a huge amount of money, hundreds of billions in quarters, in order to get their AI offerings up. Should that change how we approach these companies? Because for now, we're just trading them to the high heavens. But does a Meta, again, put whatever Mag 7 you want in there, becoming more capital intensive, change their attractiveness at all?
I think at the end of the day, CapEx is a necessity of productivity. And so if we're going to see this story play out that the market has been pricing in, we need to see the capital investment, and we know that it's going to happen at these companies. I think the silver lining here is there are multiple silver linings. One of them is that these companies have a ton of cash, right? And so it's not like they need to go into the debt markets, issue a bunch of, take on a bunch of leverage at 7, 8, 9%. They can basically self-fund, and that's a very powerful dynamic. The other thing is that from a valuation perspective, if you just look at the free cash flow yield on these businesses, it's still unlike anything we've seen in recent history. And so we maintain our conviction around these mega cap growth names on a price to earnings growth ratio. They don't look that expensive. On a free cash flow yield basis, they look reasonable. The PE multiple, I'm not sure that that's the best way of thinking about, what these companies are worth over time. And so as long as they're generating cash, as long as they can self-fund, more and more of them are paying dividends. We like that play in U.S. equities.
Potential macro headwinds is coming from the political stage, and you write about this in your note. Do you think some of this is overdone in Europe?
So I do think it's a bit overdone in Europe, and I always think it's important to separate signal from noise. And the reality is today we have a lot of noise and frankly no signal. Right, we're going to learn more here as we approach June 30th, and then obviously we have the UK elections sandwiched nicely in the middle, the second round of the French elections on July 7th. We don't know anything until we get to that point. But I think what markets are dealing with is really the crystallization of risk. And the way that we're thinking about this is it's much less about what's happening on the right. And we don't really think that the probability of Frexit, if you will, is terribly high. We're more concerned about what's happening on the left and kind of this drumbeat of unwinding all of the economic reforms that France has gone through under the Macron presidency. To me, that would put France going head to head with the EU and bring us back to a situation not unlike what we saw following the financial crisis.
So what could be the impact of that on markets?
I think you'll see the bond vigilantes reemerge, particularly in Europe. This is becoming a debt and a deficit issue more than anything else. And like we saw in the U.S. last summer when the 10-year went to 5%, as we saw in the 90s under the Clinton administration, right? Bond markets can push back against government spending. And I think that that's probably the next shoe to drop if things there don't take a turn.
Do you think people were not paying attention to this? I mean, this risk has been brewing for years, if not decades. Why do you think so many people were caught back-footed?
I think the reality is that markets don't focus on politics until they do. And, markets had plenty of other things to chew on between inflation and policy shifts. I think there was a lot of excitement. Oh, the ECB, they're going to lead us down this road of better policy or more accommodative policy. And there's like, oh, man, look what's happening over here. Well, this isn't all that good. And so it's just injected that volatility back into the market. Usually markets pick up on political issues about 3 or 4 months in advance of the election date, if you will. And so we think that, they cut it a little bit close, and calling a snap election certainly was a bit of a glass of cold water over the head. But I think the reality of the situation is that the second half of this year is going to be very much characterized by politically driven volatility. Because when you look around the world, right, we saw it in Mexico, we saw it in India, we saw it in South Africa, now we're seeing it in Europe, and then we have the fireworks here in November.
There's a real question here about where political volatility will hit the hardest. Will it be the bond market or will it be the stock market, given the leadership of some of these stocks that have real business models and real cash flow that really cannot be undermined by simply some belief or concerns on the political front? I was looking at Bank of America data showing that government debt globally has risen 40% in the past 4 years to $97 trillion. How is this shaping how you allocate or where you see risk as holding now versus, say, 4 years back?
So the short answer to your question is I think it shows up more in the bond market than in the stock market. And one of the conclusions we came to following our strategy summit last week was we actually wanted to move to a slightly short duration stance. We had been neutral on duration up until this point. Given the volatility, we just didn't really want to find ourselves on one side of the line or the other. We sat down after the 2 days and we said, look, the 10 years trading 425. We've had a couple of very cooperative data points. It feels like, markets are doing the thing where they extrapolate these data points into the future, but let's look at what's coming down the road. There's an election where in the US, both candidates are going to run on more spending. That additional spending is probably going to materialize over the course of the next few years. And frankly, we're running a 7% deficit in a non-recessionary economy. And so this is going to be a bond market issue, and it's going to be whether or not the bond market decides to stand up and say, you know what, we're only willing to finance this type of behavior up to a certain point.
When do the bond vigilantes come back in? David Leibovitz, wonderful to see you. We'll keep the commentary on stocks for another day. David Leibovitz of JP Morgan. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. More trouble for Boeing. The plane maker may have installed bad parts in its 737 MAX aircraft, according to a whistleblower. A Boeing quality inspector alleging the company mishandled and lost hundreds of faulty parts for the planes, some of which he fears may have been installed on new planes. This is according to allegations made public by a Senate subcommittee and comes as Boeing CEO Dave Calhoun is scheduled to testify on Capitol Hill today. Apple is shutting down its Pay Later program after launching it just a year ago. The program allowed users to pay off purchases of as much as $1,000 over 4 installments. The move marks a retreat from Apple to offer more financial services in-house. Recently, the iPhone maker announced that third-party services, such as ones from Affirm and Citigroup, would be integrated into its upcoming iOS 18 software. And France got their Euro 2024 campaign off to a strong start, beating Austria 1-0, but it may have come at a significant cost. Star striker Kylian Mbappe suffered a broken nose in the match, leaving him in doubt for the rest of the campaign. The French football team said a protective mask will be made for their captain, but his status for the rest of the tournament remains unclear. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. I can't look at those pictures. It's just
So
horrible.
bad.
It's just awful. This flattened face. Oh, it's terrible.
But speaking of French politics, he actually weighed in on Sunday night, telling the youth that they need to come out and vote, not accept extremists because they're at the gates of power. He wasn't saying who they should support, but he was saying you should go out and vote.
Would have been cooler if you'd done that with a bloody nose. That'd have been much cooler.
Moving on. Up next, we've got the morning calls plus the state of the housing market with Bloomberg's Drew Redding. This is Bloomberg.
Was going to keep Green World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries. The moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
12 minutes away from retail sales as we try to gauge the consumer amid a sea of confusion, otherwise underlying strength when it comes to spending, at least when in AI. Right now, the S&P just bouncing around this 55.47 level, as you do see yields just marginally higher. Not a lot going on ahead of this print that we get in just 12 minutes of time. Time for the morning calls. First up, JP Morgan raising its price target on Apple to $245 from $225 with an overweight rating. The firm boosting its volume outlook for upcoming iPhone 16 and 17 thanks to, you got it, artificial intelligence. Next up, Rosenblatt boosting its price target on NVIDIA to a street high of $200. That's up from $140. The analyst expecting new chips to continue driving value in market share. And finally, BMO Capital Markets upgrading Kroger to outperform. The analyst saying that the merger with Albertsons is a win-win scenario, even if the deal is not approved by federal regulators. Kroger set to report earnings before the opening bell on Thursday. Kind of a fascinating call that I'd like to dig more into. And after the closing bell today, we'll get results from KB Home. Bloomberg's Drew Redding joins us now for a preview. The home sector has been really interesting. We've seen a bit of concern, at least in the recent Lennar earnings, that even though orders were up in this quarter, going forward, maybe not so much given 7% mortgage rates and some of the incentives they've had to give to consumers. How much is that trend of home builders being able to lower costs for aspiring homeowners kind of run out of steam as we've gotten longer in this post-pandemic phase?
Well, I think Lennar's results show us that buyers are still responding to financing incentives. I think the issue you get into and what investors are really paying attention to is what is the impact on gross margin going forward. And part of the reason why I think there's a little bit of a negative reaction to Lennar's results is because they guide it for their third quarter gross margin below expectations, and that's going to require a significant ramp in the fourth quarter in order for them to meet their full-year guidance. So it's not necessarily that the incentives aren't working to get buyers into the door. They are. It's the fact that that comes at a cost.
At this point, how much are we seeing home builders kind of already bake in terms of their valuations, that margin compression versus still have a rude awakening ahead?
Yeah, I think there's actually has been a lot of optimism when we look into the second half of this year for gross margins to expand. And a lot of that had to do with the fact that interest rates were lower when we started the year. So the thought was they'd be able to pull back on incentives and that would support their gross margins. They're also getting better fixed cost leverage as you get through the year. But now it kind of calls that into question as rates have come back up, and we think that you're starting to see maybe a rebound in incentives. Now, rates went as high as 7.5% not too long ago. They're back down to 7 now. So there's a lot of volatility. So I think results are going to continue to ebb and flow with what we're seeing in the rate market.
Is there a sense, if we are seeing a weakening of the consumer, that we could see places like KB having to potentially cut some of their pricing?
Yeah, so builders, unlike what we've seen in the resale market, builders have been pretty aggressive in adjusting their prices to meet the market. They've done this in a number of ways. They've done it through base price reductions where they're actually lowering, the true price of the home. They're doing it through their floor plans. So they're building smaller square footage floor plans. They're building houses that are less amenitized. And then on the net pricing side, obviously, they're offering concessions, whether it's rate buy downs, closing cost assistance, or structural options to buyers.
So if that's the case, then who out of all of these home builders do you think is leading the way when it comes to actual margins right now?
Yeah, so from a profitability perspective, Toll Brothers is doing extremely well. Pulte Group is doing very well. But you have to remember, there's also business models that you have to consider. So there's certain builders who are more focused on driving higher volume sales, and there's some who are more willing to hold the line on margin and give up or not chase as much volume. So when you think of the volume builders, we're talking about the D.R. Hortons and the Lennars, whose model calls for generating, higher inventory turnover and generating a lot of cash. And what they're doing is they're applying that cash to more systematic share repurchases. And that's something I think investors really like.
One of the more interesting things about KB Home, Drew, is that they do tend to cater towards first-time home buyers or people who are trying to move up. We're trying to get signals about the consumer. We're going to get a big one today in the way of retail sales. How do we know about how this cohort is doing when we are in a world rife with people complaining that that home ownership ladder is so difficult to get onto right now?
Yeah, it's a great question. About 50% of KB Home's business is tailored towards that first-time home buyer. But I think more importantly, in the way we look at it is how does their selling price compare with the resale market and the other builders? So they're one of the most affordably priced builders out there, which we think puts them in a good position in the kind of market we're in. We have seen, and as you would expect, buyers in the entry level are much more sensitive to fluctuations in interest rates. So when you look at home builders on the lower end, like a LGI Homes, who targets people coming out of the rental market, we're seeing relative weakness there. But perhaps, you have builders who are targeting entry level, but maybe more affluent entry level buyers, dual income buyers, and we're seeing them do a little bit better.
Drew Redding of Bloomberg, thank you so much for being with us and for that update at a time where honestly housing sales and just upgrades typically have driven retail cycles in terms of spending. Here's a state of play of what we're expecting in about 6 minutes time. Retail sales, the expectation is for a 0.3% gain month over month. When you strip out auto and gas, the expectation is actually higher, 0.4% on a month over month basis. What are you looking for, Danny, at a time where a lot of people are saying it's going to be confusing given some of the warped messages from lower gas prices and some other trends?
I think really any signs of weakness. I think it's going to be another one of these choose your own adventures kinds of data sets that you can probably find what you want. But I think, for example, getting yesterday, Apple announcing that they're ditching their buy now, pay later. I think it's an interesting sort of insight into where we are in this consumer cycle, that risky things like that, companies aren't willing to stretch outside of their comfort zone. And we're not sure how the consumer is spending. I mean, we know that they're spending a lot on buy now, pay later, and they're racking up debt because of that. So at what point does that debt become a problem for spending?
We have seen some businesses slash prices, and this is going to help consumers. So that's why I'm so interested to see where they're not. Retail sales was able to pick up. When you see the companies come out, slash prices, does that mean that the consumer feels better? They're a little bit more robust? Or do we still see a lot more pressure on them? And I think that's why this retail sales number is really important.
When you talk about the sea of uncertainty or the soup that Patrick Harker seems to be swimming in, there is this issue where Citigroup's card spending data actually came out higher, actually inflecting upward over the prior month. It really is not clear. It's sort of a question also of where are they spending? Is it all vacation or is it on some of the clothing sales that people were previously talking about? We'll break that all down. Right now, heading into that, you are seeing a market that isn't doing a lot after making its 30th record high yesterday. We saw that in the S&P 500, at least at the index level, led by big tech. We are at session highs, although albeit 55.48, up less than 0.1%. Euro gaining, euro loss, losing just a touch, weakening versus the dollar as we talk about that political divide. Coming up, breaking down that retail sales data with Ian Shepherdson of Pantheon and Greg Dako of EY.
is on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Just seconds away from that key retail sales report as we toggle between optimism and pessimism around the consumer. Welcome back. This is Bloomberg Surveillance. The state of play is modest gains, modest being the operative word, on the S&P heading into the open, 55.47. The NASDAQ still outperforming, although clawing back from some of the session highs, up about 0.2%. As we do wait for retail sales, there is this question about which the surprise will be, and it is on the downside. We're just getting the numbers. Retail sales coming in month over month at 0.1% versus the expectation of 0.3%. When you take out auto sales, it actually declined 0.1% versus the expectation of an increase of 0.2%. The control group coming in also softer than previously expected, 0.4% versus the 0.5% expected. Pretty much across the board, downside surprises in terms of retail sales. What you can see is actually S&P futures getting a bid. Evidently, bad news is good news, a softer kind of tone, creating even more of a lift, possibly because there is a feeling that this is the disinflationary trend that the Fed was looking for. The revisions, before we get to the reaction in the bond market, the revisions are important. Down 0.2% in the prior month versus the flat reading that we got previously. Down 0.1% versus the 0.2% that was reported last month. Ex-auto, when you take a look at what's going on with the control group, down 0.5%. That is the revised numbers. So all around, you put it together, this is a weaker consumer that we're seeing in this picture. And what you can see in bond markets is yields off of the session highs. They are lower on the day. If you take a look at 10-year yields, 4.24%. They are down about 4 basis points. 2-year yields down about 5 basis points. To me, there's a real question here. At a certain point, how much is this good news? And it doesn't reflect a true weakening. Danny, as you take a look at this, what's your sense that really stands out to you?
My sense is that, first of all, equity markets have already given up some of those gains we initially saw, that maybe the good news, the bad news being good news, is a little bit confused. But here we go. It's a trend now? Is it a trend now? It's not completely clear, but that's what it's starting to feel like. Another month, especially when you take the revisions in hand. Is this a consumer that is finally starting to feel the pinch? And then how does that filter in to the labor market? I think that's the transmission we need to keep our eye on to really see how the Fed's going to be reacting to this data.
Especially when I saw those revisions, that's the first question I asked myself. Is this now a trend? Are these real cracks in the consumer? And actually, you're seeing this in the polling. You're seeing this in some of the survey data. But now, potentially, in the hard data, we are seeing retail sales, the revisions, and this month, downward surprise. And to Danny's point, is this now a trend?
And what you can see when you bleed this into some of the 3-month average annualized figures, you can see them coming in as a result of some of this data. We will be parsing through it. Michael McKee, our fearless leader when it comes to economic data, is not here. He is off for today. But we will keep digging through the numbers and get you some of those details about where we saw the declines most significantly. Ex-autos really does stand out to me in terms of how much that did prop up some of those retail sales. Right now, I want to bring the panel in because they probably have a better sense of this. And both of them have actually been on this disinflationary trend where maybe the balance of risks is the Fed needs to cut rates rather than hang tight. Ian Shepherdson of Pantheon Macroeconomics and Greg Dako of EY. Greg, I want to start with you. Both of you, Ian and Greg, are talking about how the balance of risks is we are seeing real weakness, and this is just a tipping point that is going to deepen. What do these retail sales do to kind of edify that feeling of yours?
I think what they indicate is an environment where you're seeing a bit of a more caution, more prudence on the part of consumers. And this is not new. We've been seeing consumers be a little bit more careful, be a little bit more sensitive to higher prices. This cost fatigue that we've been talking about for a few months now is now starting to be visible in the data. We're seeing a little bit more caution when it comes to outlays. When you adjust outlays for prices, you're actually seeing a contraction in retail sales on a year-over-year basis. Service sector spending is still relatively strong, but we are seeing more caution. And the key reason for that additional caution is the fact that you're seeing some softening in the labor market. Not a retrenching, nothing alarming, but a bit more caution in the labor market as well.
What's the gap in between a bit more caution and true weakening, given that this is 2 straight months and pretty negative downward revisions as well?
Yeah, the downward revision is disconcerting because it sounds to me like the control group now is essentially flat over the last couple of months. And it had been weakening before that as well in terms of the growth rate. So this is beginning to start to look like an entrenched softening. I mean, not a rollover, you know, it's not a disaster by any means, but it's very different to what we saw last year. Remember the second half of last year, we're looking at constant upside surprises and the consumers charging along a 3% real through the whole second half of the year. We're not going to do anything like that in the first half of this year. And I think a part of the reason here is as well as the labor market weakening, which is definitely real. You can see in the surveys that people are getting nervous about job security for the first time in this cycle, but they've also got less cash flow. You know, real income growth after tax is a lot lower than it was this time last year. Payroll growth is lower, wage growth is lower. There's just less cash around. And so people are just being a little bit more cautious at the margin. If you're a bit more cautious at the margin for a few months, it starts to build into something real.
And what it really speaks to me is if we have this price fatigue, is do corporates have pricing power anymore? We have seen some of those margins start to thin. So if we're in a world where corporates are having thinning margins, you don't have that labor constraint that you once did. Is this, as Jan Hatzius over at Goldman Sachs says, an inflection point for the labor market?
It's an inflection point for the labor market for sure, but it's also an inflection point for the inflation story as well. Because that margin expansion that we saw during the pandemic and in the year afterwards was a huge driver of the increase in inflation. And most businesses have held on to those margins, but if they're starting to crumble now, so we're actually seeing them come down rather than just hang around the highs, if we start to see them come down, it really does change the inflation picture because it was a really big part of the inflation story that's not kind of widely appreciated, but it's why I think core inflation next year goes below the Fed's target because of margin compression, and it's just beginning to creep in.
Greg, what do you think about that? Is this an inflection point?
I tend to believe so as well for inflation in particular, because we have seen more pricing sensitivity on the part of consumers. We're also seeing markups fall. We're in deflation territory when you look at some of the PPI indices for consumer pass-through. And we are still seeing some disinflationary currents in terms of the rent inflation side, and wage growth is also moderating. Put all that together, and all of the fundamental indicators in terms of inflation are pointing towards further disinflation. So if you have a forward-looking perspective, that is the right type of mix that you want to see from a Fed perspective in terms of easing monetary policy, not to bring rates down to zero, but to recalibrate monetary policy to today's reality.
So does December make sense in that scenario?
I think September makes sense. I would have actually thought that July made a lot of sense, even potentially June. You're not talking about cutting rates down to zero to stimulate the economy and prevent a recession. You're talking about how do you recalibrate monetary policy for an environment where inflation, PCE inflation, core PCE inflation, is within striking distance of the 2% target, likely to be around 2.6% in May. That is a point at which you want to start considering recalibrating monetary policy to have the optimal framework in an economy, as Ian was saying, where the labor market is gradually cooling, where wage growth and payroll growth are cooling, and where inflation is moving in the right direction.
We do hear from the New York Fed President Williams also speaking right now, actually. He's talking about that they're going to be data dependent. Well, if they are data dependent, this is the data. Do you think they need to take another look at their dots and the
absolutely.
timeline?
Greg and I are going to have an agreement fest here. but I honestly, I wish they'd cut rates last week. And they didn't, so I wish I'd cut them in July, but they probably won't. What worries me here is that they're very backward-looking, and they're constantly talking about what the data have been doing. And there's not enough discussion from the Fed about where the leading indicators, of which the US has an abundance. I mean, we have dozens of reliable indicators of the labor market, consumers, everything. And they seem to be resolutely ignoring them in favor of looking at the backward-looking stuff. And if you carry on doing that, then by definition, you're going to be late when you start cutting rates. And the danger then is that you end up with the economy slowing more than it needs to for longer than it needs to. So I think a bit of courage here maybe, and to say, okay, we don't have to wait until we're 100% certain inflation is going to get to the target, but to be reasonably sure now, I think is a pretty solid case. You know, the core PCE over the next few months, you know, is going to be 2 something, and it's not a million miles away, and yet rates are still at the highs.
If you are just joining us, we did get retail sales about 9 minutes ago, and you can see they came in across the board lower than expected, with downward revisions across the board as well to the prior month. You could see the headline coming at 0.1% versus the expected 0.3%, and a decline in the prior month of 0.2%. Looking under the hood at exactly what was driving this is actually interesting, and it speaks to some of the home builder story that we were talking about earlier. Furniture and home purchases were down 1.1% on the month. You can see building materials down 0.8% on the month. You could see this pretty much across the board. What are the parts that bolstered this retail report? Vehicles and parts, 0.8% gain. Auto dealers, 0.8% gain. You could see gas prices going down. That's gas station, 2.2% decline. But sporting and book costs, 2.8%. Glad to see that people are buying books. To me, this sort of raises this question, Greg, about how much the suppressed housing market, some people might argue the broken housing market, is suppressing retail sales in a way that's distorting the data and frankly could rebound really substantially. If rates come down, people buy homes again, they find it accessible. Is this sort of muddied data that's being skewed by otherwise kind of broken housing markets?
So the housing market's certainly frozen, but I'm not sure you're going to see a massive reacceleration in the housing market unless you see one of 2 things, or one of 3 things. 1, prices falling quite dramatically. 2, interest rates falling quite dramatically. Or 3, income growth accelerating quite dramatically. As Ian was pointing out, we have real disposable income growth that's currently at 1%. That's a really low number. You have home prices that are still high and still coming up higher and higher given the lack of supply, and you have interest rates that are unlikely to fall back quite massively given that the Fed is likely to maintain this higher for longer monetary policy stance. So I don't see that as a potential for a comeback. And if you look at the underlying drivers of consumer spending here, you have income growth that is still moderate, you have a low savings rate, and you have wealth growth that is not accelerating as much at the same time as credit is tight. So you have this bifurcated outlook for consumers where the lower end, younger generations, more indebted consumers are struggling to make ends meet in this environment.
Ian, to the point of bifurcation, I wonder if we look at this data, if again, maybe it doesn't accurately capture things if there's this housing confusion, but also the bifurcation. If you're looking at the richest people who essentially just buy assets, they buy assets, they're investing in the stock market. Does something like this give us the full picture, or is it really just capturing what we know has already been under pressure?
Yeah, I mean, the lower end of the income distribution is now under stress in a way that they haven't been since way before COVID. I mean, the fiscal stimulus, the checks in the mail, that we got through the pandemic was a huge support to consumer spending, and especially for that middle and lower part of the income distribution. You're right, at the top end of the distribution, you know, cash flow is not really important. It's all about asset prices. But the variations in consumer spending are driven by the actions of the middle and lower. And so if those people are now seeing much slower income growth than they saw last year, and they're beginning to worry a bit about job security, you know, the New York Fed survey asks people, do you think unemployment's going to go up? Are you worrying about job security? And those measures have both gone materially higher. So that's not a great combination. You know, that's a combination that tends to make people save more because of worry, but they're saving more from smaller cash flow, which means spending gets hit harder. So this is, you know, again, we're not at the point where everything's falling apart. That's not the story here, but we are, I think we've got to get out of the mindset that, you know, it's just been constant upside surprises from the consumer. Well, not anymore.
When you look at the bifurcation, and I know you pay attention to the surveys, do you see a real hollowing out of the middle class?
I think that's probably going a little bit too far. You know, we've seen very strong job growth, and the unemployment rate's been very low. And you know, nothing is better for, you know, for the middle of the income distribution than seeing sustained low unemployment. And wage growth, although it's slowing, is still pretty good. You know, we had a long period after the crash in 2008 where wage growth was less than 3%, and we're way above that now. But you know, the price level shock from the pandemic has scared people. and made them nervous and unhappy, and that's one of the reasons why the administration's poll ratings are so low. But actually, real wage growth is, at the moment, is still positive, but it's probably going to get weaker. And as it gets weaker, it just makes people more cautious.
Greg, when you look at these kind of retail sales, do you then expect potentially more companies to come out and have to say, I guess we need to start slashing more prices to make sure we can keep some of that market share?
I think you're already seeing it. You're already seeing a lot of companies think about incentives as a way to drive consumers to spend more. And as Ian was pointing out, if you look at the different income quintiles, you're seeing the bottom and median income quintiles being much more price sensitive. What does that mean? It means that they have to get greater focus on how to drive consumers to spend. But you have to do that at an affordable price. And in order to do that, you're probably going to need some incentives. What that means for the overall economy is slower consumer spending and ongoing disinflation, because those price cuts in certain sectors are going to lead to further disinflation. This is actually a positive story. It's a positive story where the Fed has to be careful to recalibrate monetary policy and adjust to that environment and not be so backward-looking, because backward-looking can be very dangerous in an environment where you have a lot of noise in the data and downward revisions a month later that show a different picture when it comes to retail sales.
Well, and to your point about this isn't necessarily a negative story, this has been one of the key questions for equity markets. Is bad news good news at a time where disinflation can potentially be positive? You could see it this morning, toggling around how to interpret this, basically lower at the moment, futures on the S&P, although they were higher. You could see yields markedly lower across the board. This from Drew Mattis over at MetLife, and I think it really crystallizes the fears that a lot of people have. He said it may seem to have been the break month. Lower sentiment, lower retail, higher claims. The question is whether this is going to spiral downward, and if so, when does the Fed recognize it? Ian, given that view that some people have, and I believe you are sympathetic to it, what is the chance of a Fed error at a time where the Fed is looking for December for a Fed rate cut?
Oh, the chance of a mistake is going up, for sure. Monetary policy works with very, very long lags. I can't stress enough how long it takes for the economy to respond to whatever the Fed does. The economy is now clearly softening, but it's 2 years since they started raising rates, 2 years. And that means that if they start cutting rates tomorrow, it will be well into 25 or even 26 before we start to see the upswing triggered by that easing. And so between now and then, potentially, we could be in for quite a long period of sluggish growth. I'm not, at this point, not terrified of a downward spiral disaster because the private sector's finances are in much better shape than you normally have at the start of a recession. But I can see the risk that the Fed presides over quite a long period of sluggish growth, which is probably unnecessary to get inflation out of the system, which is why I think sometime next year they'll end up with inflation below the target and monetary policy getting much easier. So the equity market is kind of toggling between this bad news is good news because lower rates, and also bad news is bad news because low margins. So there's going to be a real kind of push and pull in stocks, I think, over the next few months where, the rate people are just buy because valuations, and the margin guys are saying, well, hang on a minute, this is a loss of volumes and margin compression at the same time. So it could get a bit sticky.
Greg, final word?
I'll disagree a little bit with Ian for the first time.
All right.
But I think there is a risk that the economy actually worsens more because of the self-reflective interdependence between the Fed and financial markets. You have this unhealthy environment where the financial markets are trying to price what the Fed's going to do based on data, which is backward-looking, and you have the Fed that's essentially looking at financial conditions to try to evaluate how tight its monetary policy is. If you end up in an environment where there's a sudden pivot at the Fed because of disappointing economic data that's backward-looking, that could catalyze into something that's more pronounced in terms of financial markets, seeing this as very bad news and thinking that the Fed is seeing a recession down the road, and you could have this negative feedback loop that weighs on the economy. That's a potential downside risk via the financial markets channel.
The game theory of what we see with the markets and the Federal Reserve. Greg, Ian, both of you, thank you so much for being with us. Ian Shepherdson of Pantheon and Greg Dacko of EY. Up next, setting you up for the day ahead, plus David Rubenstein of the Carlyle Group joining us with the latest on peer-to-peer conversations. This is Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is Bloomberg.
Down to the opening bells. David Rubenstein in the office with an Orioles tie, which has ignited a heated debate around the
Yankees
table.
tonight, 7 o'clock.
Here is the trading diary for the week ahead, not the Yankees game. Today is loaded with Fed speak, including Barkin, Collins, Logan, Kugler, Muslim, and Goolsbee. Wednesday, markets are closed for Juneteenth. Thursday, the Bank of England decides, plus another round of jobless claims in the United States. And Friday, S&P Global PMI data. Joining us around the table after we did get retail sales is David Rubenstein wearing his Orioles tie, even though you can't see the Orioles, of the Carlyle Group, as well as, of course, a host of Bloomberg Wealth. And David, the interesting aspect of your interview this week is it's with someone who runs a $2.7 trillion wealth management firm at a time where we have talked extensively this whole morning about the uncertainty around how to position portfolios. Retail sales could be signifying some sort of rolling over the consumer or just a welcome softening. How did your guest sort of reshape the way he's viewing asset allocation and strategy at such an uncertain time?
Okay, so the person is Mike Gitlin, and Mike is the CEO of Capital Group, which manages $2.7 trillion, one of the largest money managers in the world. And their view is that the conventional wisdom, which is you can't beat the markets, is wrong. And therefore, they basically actively manage stocks and bonds, but mostly stocks. And they beat the market pretty consistently. So you don't know about them as well as maybe you should, because they work through RIAs, registered investment advisors. And so they generally, if you go to your money manager and say, give me a good mix of stocks and bonds, they probably will contract with Capital Group to actually do a lot of the stock investing. So it's not as well known publicly as, let's say, BlackRock might be. But it's an incredible company. It's been around for quite a while. It started in the 1930s. And they basically have the view that they can beat the market pretty consistently, and they have. And he is a bond person by background. And so when he came in, it was a different kind of mix than he had been expecting to do, because the firm he had been with before was also a stock equity firm. But at T. Rowe Price, he also built up their debt business, and now he went to Capital Group, built up their debt business, and nobody would have thought a debt person would have become the CEO. But he's so smart and he's so good that he basically became the CEO last year. And it's a firm that's privately owned, will never be public, I assume, and so it's not as well known. But it's a really good firm.
It's a fascinating and maybe challenging time to be an active equity manager, because you could say, look, I can buy a cheap passive fund and it gives me that exposure to the mega caps because it's market weighted, and that's all that's doing well right now. So what does it mean to be an active equity manager when you can stock pick, but you essentially got to pick 3 stocks? You got to pick NVIDIA, maybe Tesla now, and then you can outperform, but it's really challenging, that wider breadth to find the winners.
The conventional wisdom in the business schools and the academic world is you can't beat the markets. But some people who generally say that do beat the markets. So Warren Buffett has beat the markets fairly consistently. And so if you have a very good money manager and you are willing to stay with them for the long term, don't go in and out, you maybe can beat the markets sometimes. At least that's what the clients feel for Capital Group. You know, they have $2.7 trillion, so somebody must think they're doing a pretty good job. But they do it by a different technique. They don't pick one manager and say, here, you go do what you want to do, pick good stocks and so forth. They have a team of people, and the team together works on your account, for example. So it wouldn't be one person just managing your money. It doesn't sound like you're a Capital Group.
Ahead of the U.S. election.
For any money manager?
And the individual you said no.
Here's what I say about it. Look, over the last 75 years, when a president of the United States is a Democrat, the S&P 500 goes up on average in that 75 years, 6.6%. When a Republican's president over 75 years, it's gone up 6.4%. So no real difference. So if you want to play the markets in and out and jump up and down in the markets and try to take that risk, yes, you can try to figure out what the president's going to do, what the market's going to do. But over a longer period of time, the markets will probably do reasonably well under Democratic or Republican presidents. And so I think really smart money managers are not worried about what's going to happen in November, December, January, but over the longer term. So I think many people, like the Capital Group people, would say, we don't really respond to elections as much as you might think we should, because over the longer period of time, the economy is so big that no one president's going to make that much of a difference.
David Rubenstein, how many Orioles ties do you have?
This is the only one I actually have. I keep wearing it, but I'll buy another one soon.
I'm not looking to shame you for Orioles ties.
We're playing the Yankees tonight, and both of us have the Yankees and the Orioles have the best records in the American League. So we'll see what happens after a 3-game series.
All right. Are you going to head to Baltimore?
I will be at the game tonight.
David Rubenstein of the Carlyle Group. No, you're going to see AMH there saying, you know, I'm all, you know, pinstripes over here.
I would have worn my Yankees gear if I knew you were going to show up like this. So.
The Yankees are a nice team, but I think we.
Nice team.
But you know, if you ever want to come to Orioles game, let me know. Okay.
You can watch David's interview, not of Emery on Yankees, but Michael Gitlin of the Capital Group. Don't miss that at Bloomberg TV at 9 p.m. Eastern tonight, especially given his focus on debt markets, which actually makes him even more qualified for this moment, I would argue, in completely a biased way. Tomorrow, U.S. markets are closed for Juneteenth. Coming up on Thursday, Jonathan Stubbs of Berenberg, Evan Brown of UBS, Anastasia Amoroso of iCapital, and Morgan Stanley's Seth Carpenter. Right now, markets are trying to figure out how to digest a retail sales print that came in below expectations with downward revisions. We'll keep talking about that. Right now, it's a negative read. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, you know, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really it's not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. You need, this is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce half a gigaton, remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons. a year in terms of what we have to replace.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. We do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
From New York City for Wide, I'm Matt Miller. Futures hovering around zero after disappointing retail data. The countdown to the open starts right now. Yields falling, futures muted after the latest retail sales print undershot estimates. Goldman Sachs sticks to its call for 2 rate cuts this year, saying the U.S. labor market stands at an inflection point, and Citi places its services business front and center as part of its company-wide revamp. We begin, though, with the big issue, the S&P 500 notching yet another record high.
I think the bull trend continues. It may feel choppy. We may get a pause here in these early summer months. And what we've been saying to clients is this bull may turn into a buffalo and start to roam a little more, but I think the uptrend is intact.
Joining us now, Liz Ann Saunders, Charles Schwab, Chief Investment Strategist. And Liz Ann, amid a flurry of economic data, we still hit another record high. How much momentum are we seeing in this market?
There is, but it's obviously very narrow. So we're in a very rare situation where at the index level, the market's incredibly overbought, yet at the average member level, the market is incredibly oversold. So take your pick as to whether you're only focused on the index level. We continue to rip higher, but we have fewer and fewer stocks participating, and that's a risk. But, knowing the point at which you start to see convergence, that's unknowable, but it is a very concentrated market.
Yeah, you put a really interesting point in your notes, and I wanted to show the graphic to viewers as well, just to get a sense of how many stocks in the S&P 500 are actually outperforming the index. It's a very small percentage if you look at the last month or 3 months, but if you bring it out to 1 year, only 6% of S&P 500 members are outperforming the index. What does this mean to you?
Well, so having a market that is concentrated and having cap-weighted indexes be driven by a small handful of names in and of itself is not necessarily a problem. That can last for an extended period of time. The problem arises when the rest of the index, the rest of the market is significantly underperforming, when you have that significant bifurcation. And that kicked in earnest in last year and then started to ease a little bit and really started to ease when we hit the peak in yields at the end of October. The move down then became a huge tailwind for the equal weighted index relative to cap weighted for small caps, but that was somewhat short-lived, particularly as yields started to move back up again. So it's that spread. And what I would like to see is a little bit of a pullback up the cap spectrum in some of those high flyers, but at the same time, some sort of under the surface subtle improvement in breadth that may not be picked up by index-oriented investors, but that would be a positive divergence. We're just not seeing that at this point.
What's your view on the economy right now, Liz Ann? Because Jan Hatzius over at Goldman Sachs says GDP growth has slowed meaningfully, and they're sticking with their call of 2 cuts this year, but they point out that, the labor market is showing us mixed signals. We got non-farm payrolls adding jobs. I think 273,000 jobs at the same time. The household survey lost 400,000 jobs. How does the economy look to you?
So I think the economy is slowing. Retail sales certainly supports the consumption side of the economy being weaker than what we've seen in recent months. And, to your point, Matt, about the payroll data versus the household survey, for what it's worth, at inflection points in the economy, when you're in a slowdown, the message from the household survey tends to be the more accurate one. Not to mention the fact that there is so much buzz and chatter about the QCEW survey that suggests that payrolls on a monthly basis are probably overstated to the tune of 60 to 70,000, in part because of the BLS's birth death assumptions that they make. That's the birth of death of businesses, obviously, not of people. And so I think when we get the annual benchmark revisions, which is not until it's February or March of next year, I think you're going to see the payroll data catch down to the household data. So I think we are seeing a material softening, nothing disastrous, but it witnessed in the labor market. And that goes back to why the Fed might be able to start easing policy absent a move down in their core PCE favored inflation metric to their target. It is the labor market may give them the green light to start easing in advance of that inflation target being hit.
So, we can see this slowdown, right? If you just look at the GDP prints. At the same time, Lizzie, and corporate profits are picking up, right? We've had this expansion over the last 3 quarters. In a note from ISI, Julian Emanuel said he expects corporate profit to grow 8% this year, 5% next year. He raised his target on the S&P to 6,000. How do you square that circle with the economy slowing down and corporate profits really doing well?
Well, it shows that companies have done a very good job in the aggregate of maintaining profit margins, because where we have seen much more weakness is in top line growth. So for all the justifiable cheering of bottom line growth, earnings growth, near record high in terms of the beat rate, percent by which companies are beating, you have nowhere near that same strength on top line growth. You see a below average revenue beat rate. The level of top line growth is much lower. And for what it's worth, it's revenue growth that tends to be a driver of what happens in the labor market, what companies opt to do in terms of cutting costs on the labor front. A lot of the cost cutting has been outside of the labor market. I think this next reporting season will be interesting in the sense that from a forward-looking basis, we will see in a more constrained top-line growth environment how companies are going to be able to continue to maintain those profit margins. Does it start to eat into labor costs?
How do you talk to clients about portfolio construction right now? I guess, rebalancing is a term I've heard a lot over the past couple of days, and yet, as long as you left all your eggs in one S&P 500 basket over the past 15 years, you're outperforming pretty much anything else that there is. How do you deliver clients the message that they need to stay safe and diversify?
Well, on the rebalancing front, first of all, it's always a great discipline. It's one of those beautiful disciplines that forces us to do what we know we're supposed to, which is a version of buy low, sell high. It's add low, trim high. When left to our own devices, we tend to do the opposite, or at least let the winners run. But one maybe subtle shift we've made in terms of recommendations around rebalancing is a lot of investors, certainly on the institutional side of things, do their rebalancing based on the calendar. Mutual funds tend to rebalance the final week of every quarter. A lot of individual investors do it on an annual basis at the end of the year, maybe something tied to tax liabilities. But we're suggesting that if the maybe additional turnover doesn't impact, consider portfolio-based rebalancing, actually letting shifts in asset classes or individual stocks dictate when it's time to maybe pare back and take some profits and add to areas that have underperformed. And I think particularly now that's an important discipline, because a lot of the research shows that particularly down the age spectrum, there just has not been a lot of rebalancing. And it's great when the S&P is outperforming everything else and that cap-weighted index doing well because of the high flyers. That doesn't last forever. And the downside, of course, is the downside of these cap-weighted indexes. You have a concentrated weight in names that at a point of convergence can cause more angst.
So does that mean, take profits from the Magnificent Seven? Does that mean sell off some NVIDIA and buy some REITs?
Well, I'm not going to make recommendations specific to any individual names. That's not what I do. I fly around at the 30,000 foot level. But I think, paring back along the way without honing in on any particular security, what's your ultimate goal? What is your overall asset allocation? What's your exposure to equities that make sense? Understanding the concentration risk and the potential peril of that, and whether you can handle the pain, inevitable pain on the downside when you get some reversion to the mean. Right now, you mentioned specifically enroll into REITs. We happen to have an underperformed rating on REITs, so that wouldn't be our specific recommendation. But I think there are still opportunities to stay up in quality, but move away from some of those high flyers, certainly as it relates to new money being put to work within portfolios.
Lizanne, great to catch up with you. Thanks so much for joining us on the program. Lizanne Saunders there of Charles Schwab. Joining us now with a look at some of the individual names moving ahead of the opening bell is Bloomberg's Abigail Doolittle. Abby, what do you see?
Well, it's interesting, Matt, because beneath the relatively benign surface, we have lots of big movers. Let's, of course, start off with the AI-related names, because Broadcom right now is heading to an 8th straight up day in a row. That would match the longest winning streak going back to 2023. So after that big quarter and, again, the AI strength, investors flocking to the shares of Broadcom, although a little bit off the highs after that retail sales report. And same deal with NVIDIA. This stock had been higher. Rosenblatt did raise its price target to a street high of 200 on the software aspect. Those shares up ever so slightly. Let's keep it going, though, with the chips, because we do have Micron trading higher, too. And this after Bank of America saying that the AI play, it's not directly related to Micron, but that memory and storage could do well on AI. And that's one reason to like Micron and ARM, for that matter. Lazy Boy really surging, up 9.3%. They put up a good quarter, and their outlook was also positive. Not even a huge short interest there, so that's genuine buying. And then finally, to the downside, we do have Philip Morris trading lower, and this after they stopped their online sales of their popular nicotine pouch brand Zyn in the U.S. after receiving a subpoena in D.C. related to flavored products.
Interesting. I know it's been all the rage among the kids, the Zyn packs. We used to call those bandits, but it's a little different. Abigail, thanks very much. Abigail Doolittle talking to us about some of the stocks on the move. Lazy Boy, a big gainer, up by 1/10 today. Coming up, it's a busy week for housing data. Those two maybe go hand in hand. We'll discuss value opportunities in real estate with David Auerbach of Hoya Capital next. This is Bloomberg.
In tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question. Best question I get all night.
Bloomberg, top experts, great questions. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
We are watching homebuilder Lennar this morning. Shares falling after it delivered a weaker than expected outlook for the third quarter. After the bell, we're going to get more results from the real estate space, KB Home to be specific. Drew Redding, Bloomberg Intelligence U.S. home building analyst, joins us now to give us the lay of the land. Drew, I saw, mortgage applications absolutely soared last week. What's it telling us about the rest of the industry?
Well, you have to remember they're soaring off a very low base. If you look at sales of existing homes, we're still down about 35% from early 2021. We've been describing the housing market as a tale of two markets. You've got weakness in the existing home market with relative strength in the new home market as builders have had the supply and they're able to make the math work for their buyers by buying down mortgage rates.
How much do rate cuts from the Fed matter? I mean, as we all know, they've only penciled in one in the most recent dot plot, down from 3 in the previous print. Is that a bummer for the housing industry?
Well, I think it's certainly something investors are latching on to. We came into the year looking for 5 or 6 rate cuts. We've pared that down to 1, and you've seen the stocks kind of ebb and flow with those expectations. In terms of demand in the market, what we've heard from the builders is that 5.5% mortgage rate is kind of that sweet spot that really gets buyers into the door. So if you're looking at a headline rate that we are right now of about 7%, builders are able to buy that rate down to about 6%, and in some cases 5.5%. So, if rates stabilize or pull back a little bit into the mid to high 6s through the end of the year, we think that from a rate perspective, the builders should be okay.
Is family formation a problem right now, Drew? I mean, are people having enough babies and going out with housing demand?
I think in the near term, household formation is still very strong and supportive of the housing market. You mentioned birth rates. I think that's something that could impact the market, but that's something that we're looking at way down the line. In the near term, the demand's there. It's just how much are buyers willing to pay. And I think that the fact that in the new home market, monthly payments are almost at parity with resales. So I think that's one thing that's helping the builders out here.
All right, Drew, thanks very much. Drew Redding there of Bloomberg Intelligence covers the housing market for us. For more on real estate, David Auerbach joins us. He is the CIO at Hoya Capital. Hoya specializes in managing portfolios of publicly traded real estate securities. You have your own ETF, REIT, right? R-I-E-T rather than R-E-I-T. Talk to us about if we're at a low, if we're maybe at an inflection point here for real estate investing.
Well, if you talk to the publicly traded REIT guys, they would say that we've, on the way to turning the corner. Looking at previous cycles, a lot of these REITs have been able to hunker down, improve their balance sheet, lower their leverage, dividends are increasing, earnings are increasing. And so by and large, even though we hear these headlines of doom and gloom, commercial real estate wall of debt, all of these negative headlines, talk to the individual REITs themselves and they're like, no, fundamentals are strong. We're able to properly manage our debt stack over the next few years, focus on the operations and look at the bigger picture.
Right, and this is kind of what we heard from Bill Gross on the close last week. He was talking about, regional banks that he thinks already have put enough aside to deal with any fallout. But in terms of the price action, I mean, it can be doom and gloom. If the price is down far enough, it's a good entry point, right? Do you see that across the space?
Absolutely, especially in some of the small and mid-cap REITs. We think some of these guys are extremely, frankly, deep value plays. If you look at across the 11 GICS sectors, real estate, the bottom performing sector. Look at year-to-date performance, real estate, one of the worst sectors. But yet, again, FFO, the REIT earnings number continues to go up. Dividends continue to go up. Over 50 REITs have raised their dividends so far this year. We focus on the REITs that pay the highest dividends with the lowest leverage ratios. And so we kind of ignore this wall of debt looking at the individual constituent level.
The GICS sector, that's a jargon alert is what Tom Keene would have said. You're talking about the
S&P.
Industrial breakdown on the S&P. Yes. We can pull that up on the Bloomberg terminal with the GRR, the group rank returns. If you look at it year to date, you're right. It's the biggest underperformer. It's the only one in the red here. You can see real estate at the bottom. Obviously, IT and communication services are there at the top. REITs are not a monolith, right? This country is broken down into many different regions that are all performing at different levels. Where do you see the winners and the losers in those terms?
Sure. So if you look at on a sector by sector basis, obviously some of the sectors like industrial, single family rentals, data centers, those sectors have been on fire. If you look at regions, Sunbelt apartments obviously been in focus, Sunbelt industrial, where Amazon goes, that's kind of dictates where things are heading. And so in certain cities as well, like New York, there's pockets of strength, there's pockets of weakness. I mean, it's almost on a sector by sector or a street by street basis. Perfect example is Blackstone. Blackstone, in one hand, is buying in certain markets, and in the same markets, they're selling assets. Right. Look at what's happening with their private REIT vehicles, both with Blackstone and Starwood. And because of what's happening in some of these vehicles, this provides that opportunity for some of the publicly traded REITs to potentially acquire some great assets at great prices because of the strength of their balance sheets.
Right. I see it. I'm from Granville, Ohio, and Intel is building a huge plant right down the road from us, and as a result, home prices in some places have just doubled.
But it's also going to lead to more apartments, more single-family rentals. I was in West Village yesterday looking at Google, Apple, Samsung, all of these new companies that are moving into the area, but there hasn't been a big residential component that's followed along with all these companies going. And so when you kind of look in the microscope or the crystal ball of 5 years down the road, West Village's example is going to look completely different on the resi side than it does today. And again, it's going to be some of the publicly traded REIT guys that are the driver towards that.
In terms of commercial real estate, I mean, people describe it as a slow motion train wreck, right? I think Bruce Richards from Marathon was on the close yesterday saying it's the story of the python swallowing a pig. How far along is that pig?
I would think, especially since the REITs have been in this higher for longer, or not just high for long environment for a couple of years, we're operating in an environment where we know there's only going to be maybe one rate cut this year, maybe. And so as a result, I'd like to think that we're pretty far along in this beat up situation, especially for those companies that are exposed to variable rate debt. Since so many REITs have a huge component of fixed rate debt, they're able to navigate these waters pretty easily right now. Obviously, should we see an uptick in rates or things turn, then obviously, again, the variable rate situation changes. But from where I sit, the 10-year Treasury is trading around, I believe, 4.25 right now. The average REIT dividend yield, when you include mortgage REITs, is around 6.9%. So that gap is widening between REITs and fixed income. For us, running the high dividend yield REIT ETF, when you also include the layer of preferreds, we're paying an index dividend on a monthly basis that's annualized over 10%. Because we're seeing opportunities in small and mid-cap REITs, in mortgage REITs, in preferreds, we just take a completely kind of contra approach that some of the large cap, equal market cap weighted players do.
How much do rate cuts matter, and what do you expect?
I mean, dramatic. I think, as I like to say to folks, when the Fed announces the rate cut, hopefully whenever, September, December, when they make that announcement at 2 o'clock, at 2 o'clock in 1 second, the REIT sector immediately responds. At 2 o'clock in 2 seconds, when the advisor calls their client to be like, hey, the Fed cut interest rates, it's time to buy REITs, that ship has already sailed. So it's our job to try to educate investors and advisors why it's important to start increasing or positioning towards REITs today for what's inevitably coming down the road tomorrow.
All right, David, great to get some time with you. Thanks so much for coming into the studio here. David Auerbach there of Hoya Capital. His ETF is REIT. RIET, so the opposite of REIT.
Because income comes first.
Income comes first. All right, a great pitch there. Coming up, the morning calls, and then later, Invesco's Ben Guttridge joins us, and we'll discuss why he finds European equities appealing, even post-snap election call. This is Bloomberg.
other authorities.
Could face bigger challenges next.
It was going to keep Great World Cup. This is a 3 as the economic picture, covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
All right, taking a look at this market, we're climbing a little bit in terms of futures, not much, but at least the arrow is up and the color is green. It's so important to watch the economic data. So if you have a Bloomberg terminal, EcoGo is your friend right now. Maybe more important than the Fed speak that you hear. This morning we had retail sales that were disappointing. This number turned red. Then we had industrial production, figures that were a little bit better than anticipated, and now we see a little bit of green here. So keep your eye on this space, still at a record high. On the S&P 500, we hit 54.73 in the cash trade yesterday. Time now for our morning calls. Take a look at some of the analyst recommendations on Wall Street this morning. First up, Rosenblatt Securities raised its price target for NVIDIA to a street high of $200 from $140. The analyst emphasized the strength of the chip maker's software alongside its hardware. Next up, BMO raising Kroger to outperform with a price target of $60 apiece. The analyst says the supermarket chain is well positioned whether its deal with Albertsons happens or not. And then finally, Apple downgraded to a neutral at Phillips Securities while increasing the firm's price target to $220. So they still have moved their price target up. Obviously, the price is almost there right now. The analyst says the newly announced AI features will trigger a replacement cycle. You're going to want to go out and buy new iPhones if the one that you have doesn't enable you to work with the AI that they're bringing out. Coming up, Ben Guttridge of Invesco joins us on the Goldilocks, what he calls the Goldilocks environment for stocks. Is it still there? This is Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments, Through August 2023, the company raised over $1 billion from investors, including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I want to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
This is Bloomberg.
This is the countdown to the open. I'm Matt Miller. We're just moments away from the start of trading, and we're seeing futures, at least on the S&P contract, fluctuate between gains and losses. We were down this morning after retail data disappointed, then industrial production data impressed, and we're up again, but still basically hovering around zero. And why not? We hit a 30th record high on the S&P yesterday at 54.73, so investors remain bullish. There you heard the opening bell on the New York Stock Exchange and down at the NASDAQ site. And you can see in terms of futures, not a lot of change. Let's take a look at some of the other instruments that we watch. The euro has been interesting to watch lately as it's fallen back down below 108 to 107.33. We're going to talk to an investor in Europe to see his take on what's going on with these assets. The 10-year yield in the U.S. at 424, 425, and NYMEX crude right now up over $80 a barrel. In terms of stocks to watch at the open, Chegg is one of those stocks. It's jumping after the online education platform announced a plan to cut 23% of its global workforce. That plan also includes a push into AI. So it's happening. The robots are replacing us. Here with more is human Abigail Doolittle. Abby?
Very human, thankfully, Matt. And there's a lot of things to point out about this. First of all, a lot of people into today probably had never heard about Chegg. Second of all, yesterday, Chegg was at an all-time record low, having been down 7 days in a row. Third, this is a penny stock. In 2021, it was a greater than $100 stock. So the fortunes for Chegg into this big surge have not been so great, in part because profitability was much more significant in 2021 when they put up 57 cents per share. This year, they're modeled for a loss of 4 cents. So investors are very excited about the possibility that they are going to drive costs and they are going to drive growth and cut costs. The plan, the workforce plan, is to cut 441 employees from their company. Relative to the stock today on this, we do have a pop of about 12% right now, the best day going back to November of 2023. I would note there's not surprisingly a big short interest on this, nearly 20%. So today is a bit of a squeeze. Let's see how this one goes as more time moves on and to see whether or not they accomplish their new goals.
All right, Abigail, thanks very much. Abby will be back later on in the program. Right now, another company riding high on AI is Broadcom. It's set for its longest winning streak of the year. It had an awesome week last week and continues in this week's Trade. For more, we're joined by Bloomberg's Emily Grafeo. Emily?
Yeah, Matt, we'll see if those gains hold into the end of the day because that will make it the longest winning streak of the year. But now it's only up about 0.2%, oscillating between gains and losses after the opening bell. But nevertheless, that stock has been on fire, adding $200 billion in market cap just over the last week or so. And the moves today follow blowout earnings last week, which showed that strong demand for nothing other than AI, Matt, has really been driving Broadcom's growth here. The chip supplier supplies products for big tech companies like Apple, and it offers a range of components that are used in computing and networking. So the AI frenzy in the market has really been a big boost for Broadcom. You look at what Barclays has to say, Broadcom remains one of the best ways to play AI, and the rest of the street feels the same way. 36 buys, 7 holds, and 0 sells for Broadcom, Matt.
All right, Emily, thanks very much for that. Now turning to the sky, Rocket Lab shares are lifting higher after announcing the largest launch agreement in the company's history. Joining us now is Natalia Knijevich on Rocket Labs.
So the stock is up by 8%, Matt, today. That is the biggest, as you said, agreement for the company. The customer is a Japanese space company, and it's been a long-standing customer for Rocket Lab. So now, basically, this is a commitment for 10 launches until 2027. The terms of this agreement were not disclosed, but investors really liked this because basically this shows visibility for a long-term pipeline. And some analysts are saying this could probably be an example for other customers to make similar commitments. But we do have this excitement today in terms of the stock price, but overall, year to date, the stock is down 22%. A few reasons behind that. So the last quarterly report showed that revenue was lower than analysts expected. They also had an unsuccessful launch last fall, and the company is working on a very big project. It's a big rocket called Neutron, and as of now, the company produces small to mid-sized rockets, but this project could allow Rocket Lab to be a direct competitor to SpaceX Falcon 9. But again, this project requires lots of investments.
All right, Natalia, thanks very much. Natalia Knijevich there on Rocket Labs. By the way, in the next hour, we're going to speak with the CEO of Rocket Lab, Peter Beck. Sir Peter, to be exact. He's gotten the Lord title since, is a Lord? I don't know. He's a sir, in any case, is what we say. Joining us now is Ben Guttridge. He probably knows better than I do about these titles because he's the investment director of investment solutions at Invesco and is over there in the land of lords. Ben, first of all, let me get your take on French stocks and the effect of the snap election that's coming up. It seemed like investors were all going to pile back into Europe. You saw the stock 600 really start to pick back up, and then this kind of freaked people out, Macron's call after the win for the far right there. Is everybody going to now abandon the continent?
Well, in answer to your original question, it's actually a knighthood.
Oh, sorry, he's a knight. Yes, yes.
In relation to French stocks, I think we've sort of seen this type of movie before. It's sort of a classic reaction from markets. Hedge funds get their new toy, and they sort of respond, sell down on sort of negative political developments. I mean, the concern is that a populist, sort of quite far right party take over the French Assembly, the French Parliament, but doesn't take much digging to appreciate that the probability of that is very low. So we don't expect any type of French exit from the EU. Far from it in terms of policy agenda. Any abandonment of the euro. There's a bit of a roadmap with what we saw in Italy, as some might consider more of an extreme sort of party securing power and adopting more moderate policies. And when they reach the pearly gates, when they reach that position of authority anyway. So I think the markets have overreacted here and therefore suggests a bit of an opportunity.
An opportunity because people do tend to freak out at these things. Where do you see the biggest drops, the biggest losses, the biggest entry points in terms of European stocks and bonds?
Well, I think it would have been sort of the utilities that have seen the biggest drop. They had the closest relationship with sort of government bond performance and French bonds really taking a bit of a hiding, certainly relative to other European bond markets. But that's also sort of bringing to markets' attention that the public finances in France aren't quite as neat and tidy as in other nations, certainly relative to Germany. So it could be a little while before French bonds recover, and therefore that discount in utilities might narrow, and therefore you think on a sort of a risk-adjusted basis that it's probably French financials, the banks, that look like the most interesting opportunity. Yes, some linkage to bond markets, but not as keenly correlated as utilities. And we think the growth outlook is pretty reasonable in Europe at this moment. The ECB cutting interest rates, real incomes looking reasonable, so wage inflation okay relative to fading inflation. So on that basis, the banks look like a better trade in amongst the opportunities that are presented.
Does all that, though, Ben, look better to you than, the AI boom that's going on over here? Do you feel like it's run its race already, that there's no more room for higher highs?
Well, I mean, I don't trade particularly short term. In the very short term, one might suspect that these sort of European discount opportunities do look more appealing given the relative performance of late. But over the medium term, I wouldn't say so. No, I think we'll be continuing to leaning into US equities, particularly those of sort of loosely defined sort of technology theme, the home of innovation, and this tremendous AI earnings momentum that we're seeing. Recognise it could be a bumpy ride, but would not want to take that exposure away from portfolios at the moment, given the tremendous earnings performance we're seeing and the seeming inability for investors to be able to value these companies appropriately.
I wonder, when you look at what's happening in Europe, it's already kind of happened in Britain, is that the status quo is essentially thrown out for an alternative politically. Does that make room for a growth in a tech industry that has never really been able to flourish over there, but has done bonkers good here in the U.S.? I mean, are you starting to see that in London? Do you expect to be able to see that on the continent?
Well, I mean, there is sort of an underappreciation of technology businesses in the UK, but they're clearly not as dominant as they are in the US, and likewise on the continent. But of course, ASML is just almost sort of a linchpin in this sort of semiconductor industry, but it's clearly not such a dominant a stock within the market. I mean, it's just going to be too hard to displace the US as the home of innovation and technological innovation. But, there are opportunities in European equities to exploit this trade. I've mentioned one name already. But for the asset allocators, if you want to get a more meaningful piece of this trade, of course, you have to lean into the US.
In terms of growth there, we see it kind of slowing down here. You've already, or the ECB at least, has already started cutting. They didn't really give us a path forward, but what does the growth picture look like to you as the ECB contemplates further cuts?
Well, I think it looks pretty reasonable, pretty downbeat expectations for Europe by and large. But as I said, a combination of real income support, so wages continuing to running at quite a reasonable level, but inflation falling much faster on the continent than in the US, for example, is giving consumers room for manoeuvre. And we are starting to see all is increasing evidence of the manufacturing sector doing reasonably well. So that's good for Europe, really heavily integrated in the manufacturing sector. You take an economy like Sweden, something of a lead indicator on sort of global trade and global manufacturing. Their PMIs, their leading indicators suggest manufacturing is picking up. So that's good news for Europe. Over the medium long term, we're well aware that the sort of structural challenges of such a fragmented market in Europe and the links to China and all the challenges there don't set Europe up for sort of sustained long-term higher levels of growth. But in the shorter term, perhaps the growth outlook looking a little better.
It is so fragmented. The EU, not a monolith, as we get painful reminders of time and time again. You mentioned Sweden. We talk a little bit about the UK. Where do you think are the best regions to invest in Europe?
Well, I mean, I would say the UK, but that would circle back to our prior earlier in our conversation, where we think the US looks set up to be the best performing market over the medium term. And what you're getting there is sort of tech-heavy exposure. To build diversified portfolios, you need something of a hedge against that. And the valuation opportunity in the UK and the geopolitical hedges of the resource sort of dominant sectors that are in this market make that a nice barbell. Within Europe at the moment, over the short term, France looks like a decent opportunity. There's sort of shorter term discounts, but of course it's home to such great luxury brands as well, and such fantastic technology businesses. So there are opportunities everywhere, but on a high level, we think US, UK makes like a nice barbell.
Got it. Ben, thanks so much for joining us. Hope we can get you back soon. Ben Guttridge there of Invesco talking about the situation on the other side of the pond and what kind of opportunities the concerns open up. Coming up, Ryan Reynolds joins Mountain, or he has joined Mountain a while back as Chief Creative Officer. He gives a go at pitching the business in a new campaign. We'll go live to Cannes and speak with the Mountain CEO, Mark Douglas. Look at how streaming giants are spending ad dollars. This is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
It's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you got to be smart about this.
The top voices in advertising and media are gathered for the Cannes Lions Festival in southern France. One focus is how streaming giants are changing advertising. Joining us now is Mark Douglas. He's the CEO of Mountain. It's an ad technology company that builds software for brands. And Mark, great to have you on the program. You have a chief creative officer in Ryan Reynolds.
Yes.
And he has recently made an attempt to kind of pitch the business, your new program, Mountain Match. Tell us what's that about and what's it achieving?
Yeah, so one of the things that Mountain is entirely focused on is bringing small and mid-sized businesses into the television advertising market. And so these are direct-to-consumer brands, usually e-commerce brands or travel brands coming to television for the first time. They don't have huge budgets. So they have a hard time, they're not broadcasting out millions of dollars on the TV. So we have to really identify their right consumer and kind of literally match them. Like, this consumer, you would love this brand. And then we make that match via the TV ad. So we released something called Mountain Match, which uses 2 layers of AI, generative AI and machine learning, in order to literally match consumers with the right brands and then show them the TV ads for products they're potentially going to love.
And of course,
when
when you linked up with Ryan, I mean, that was kind of what he was famous for. It's his sort of creative genius in creating ad campaigns matched with your sort of engineering technology at Mountain. Helps you take on sort of the Goliaths. Amazon, I'm guessing, and Netflix are 2 of those Goliaths, right? How do you deal with those 2?
Well, we're partners with every streaming network in America, all of them. And we're bringing 90% of our customers have never advertised on television before. So that's a huge stat. And so they love Mountain is bringing these new advertisers in the market. But again, these customers, they're used to using paid search and using these super targeted platforms to find the right consumers. So they need that kind of technology in order to get access to Mountain customers, to get access to this new cohort of customers. And so they're excited about it. I think they're battling each other. And meanwhile, Mountain is above the fray, just like bringing new companies into this market every single day.
So how strong is the sort of comeback of advertising on television? Because for so long, Mark, I could stream stuff without seeing any kind of traditional commercials. Now, when I'm watching things, for example, on Hulu, they do pop up every 30 minutes or so, and I will, sit through and watch.
Yeah, it's very back to the future for TV advertising, and there's no TiVo anymore, right? And so it's all 30 seconds, unskippable. But what's happened is the quality of the ads themselves have gotten better. And then, like what I'm talking about, Mountain Match and other technologies are making it so that they're way, way more relevant. So those consumers that are now seeing the ads that maybe they weren't through a subscription, they're willing to trade that because they're much more relevant. They're almost part of the entertainment increasingly, if they're good and they're very, very relevant. So I think it's, the industry is growing. I think there was a bit where it was stalled, but it's kind of growing, and it's because it's more relevant, more brands, like Mountain bringing more brands in the industry. It's just making a big difference.
So you're there in Cannes, and Elon Musk is going to be courting advertisers in Cannes, apparently in a speech or an interview, rather. Give me your take on what the Tesla CEO, the Twitter CEO, the SpaceX CEO is doing, because a lot of people wonder, does this guy have a plan? Is it headed somewhere, or is he just like throwing spaghetti at the wall all the time?
Yeah, so I think obviously Elon is one of the biggest innovators of our time. I think people would probably think Steve Jobs, and these days think Elon. And Elon's doing it in the physical world. He's launching rockets. He's building cars. With X, it's software. And I think a lot of folks are just not that used to seeing someone innovate in real time and do it so publicly and announce ideas and then, change his mind. And I think that kind of seeing how the sausage is made kind of freaks some people out. But it's part of the process. And so I think someone like me, I'm an engineer originally by trade. I mean, I think we see it as fantastic because that's the process. But the rest of the world sees it as schizophrenic, maybe is the right word. But it's all headed in the right direction. I'm a big fan of everything he's doing, including what he's doing at X. I think he will get there, and I've said that for quite a while now.
Mark, we have a viewer writing in with a question. He asked, do you think Silicon Valley is going to keep picking away at traditional media? How can anyone compete against Silicon Valley with an endless wallet to buy content?
Well, the thing is like these mediums like television, even billboards, what's referred to as out of home, have become digital, and Google and Meta play no role in them and won't be playing a role. So I think, yeah, the Google and Meta are now competing with an entire industry of media companies who are now armed with digital technology themselves, and I think it's, you know, battle royale right now, and it's a fun time to be participating in it.
All right, Mark Douglas, thanks very much for joining us, CEO of Mountain from Cannes Lions. Now, for some of the sector price action that we're watching in the market this morning, let's get back over to Bloomberg's Abigail Doolittle. Abby?
Right now, we have the S&P 500 heading to another high, Matt, another record high, closing record high, an all-time high, and it's a broad-based gain sector-wise. Energy is the top sector, up 1.6%. We have a bit of a reprieve here for real estate, the only sector down on the year, right now up about 0.6%. To the downside, communication services, utilities, discretionary industrials, but a small gain that is well supported. Let's take a closer look at that energy sector because it has been steadily higher, and one piece of it is Occidental. Warren Buffett adding to his favorite energy bet, buying for 9 straight days in a row. The stock up 3 straight days in a row, and you can see today's spike there.
All right, Abby, thanks very much for that. Coming up, we're going to give you the market-moving events you need to watch. That's next in our trading diary. This is Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
For the trading diary, what you need to be watching today and this week. Later today, we're going to get the tick flows, so pay attention to those. And then obviously a slew of Fed speak will continue this afternoon. Tomorrow, U.S. markets will be closed for Juneteenth. And then Thursday, we get the Bank of England rate decision. You can type BOE GO on your terminal for that. And we round out the week with existing home sales. This was the countdown to the open. I'm Matt Miller. This is Bloomberg.
you are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
Right? And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me. And I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are 2 big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube, so head over to youtube.com and search Bloomberg Podcast, and that's where you will find all the video offerings. Coming up, we're checking with Ira Jersey, Bloomberg Intelligence rate strategist, to figure out where this market is going, where the Fed is going, and how the economic data is affecting the bond market. George Ferguson, Bloomberg Intelligence senior aerospace analyst. Talk about Boeing here. It just can't get out of its own way here. It's a great American company, aerospace company. You would just wish better days for them, but they've got some challenges there. Drew Redding, Bloomberg Intelligence home building analyst, can talk to us about the home building business. Lennar, big home builder, had some numbers that were a little bit light here, so we'll break it down with him. But right now, let's go to Lisa Mateo and get a Bloomberg business flash.
You got it at Market Drivers, brought to you by Interactive Brokered Bond Marketplace. Access their vast selection of over 1 million global fixed income securities with no markups or built-in spreads and low transparent commissions. Learn more at ibkr.com/bonds. All right, stocks, we've got red and green on the screen after some mixed economic data. On one hand, you have U.S. retail sales barely advanced in May, and prior months they were revised lower. But on the other hand, May industrial production, that beat estimates, rising 0.9% month over month after no change in April. So right now we have the S&P 500 up 0.1%. Same for the Dow. We have the NASDAQ, little change, down about 10 points at 17,846. The 2-year yield, 4.71%. That's down 4 basis points. The yield on the 10-year, 4.25%, down 2 basis points. We'll take a look at spot gold right now, higher at 2,325 an ounce. We have Brent crude, $84 a barrel. WTI crude at $81
$100 a barrel. Bitcoin, want to point that out because it touched a 1-month low. It's now down about 2% at 64,800, just about. And that's pulling most crypto stocks lower too. We have Coinbase. Coinbase down about nearly 3%. And we have Marathon Digital Holdings. They're down about 3% as well. That is your Bloomberg Business Flash. Alex and Paul.
All right, thanks so much, Lisa Mateo, Alex Steele, alongside Paul Sweeney. Bloomberg Intelligence Radio. We bring you all the top news and analysis from our great set of team over at Bloomberg Intelligence. I overslept.
Yeah, let's explain what happened.
Third time in 17 years I overslept. Now, I didn't miss the show. I got up at 7 versus 6, so it's not dramatic, but I can't get it together today.
So, and the coffee routine's all off and everything.
The coffee's messed up now. I had to actually commute on a subway train versus a car. Wow. I mean, I was roughing it today. So we're going to be grateful if I get through today. Anyway, stock's not doing that much. But individually, there are some good movers. So luckily, Carmen Reinecke, who didn't oversleep, is here, and she's going to help break us down for us. So you're looking at Chegg. What is Chegg? What's going on there?
What if I did oversleep? No, I didn't.
Did you?
No, I didn't. I didn't. We're not going to try not to jinx it. So Chegg is an online education firm. Shares are up about 16% right now. This is the best jump since November. Basically, this company reported earnings. It said that it would cut its global workforce 23%, and it finally sort of gave a plan for growth with artificial intelligence. So this has kind of been seen as an AI loser. Shares are hugely beaten up this year. It's down more than 70%, and so this was, a really necessary development.
It down? Remind me why this thing was down. Was this kind of just down because people thought AI would put it out of business?
Exactly, yeah. It was really seen as sort of like a loser in the space. It's something that, would just get wiped out by AI. And, I think this idea that it's embracing it and it has a solution here has been really positive for shares.
Also, I should point out the short interest was really high too. Okay. So that could also help explain this kind of reaction in the equity market as well. What else you got?
Yeah, so I was also looking at Philip Morris this morning. The stock is down about 1%. It's sort of paired a little bit of a loss. Basically, the company said that it stopped online sales of the nicotine pouch brand Zyn after receiving a subpoena in D.C. related to flavored products, which are banned there. So basically, an investigation shows that there had been some sales of these flavored products in D.C., or the pouches in D.C., online, and some independent retailers. The thing that I think is also really interesting here is analysts raise the possibility that enforcement actions could go beyond the D.C. area. So, obviously, nicotine products are always, I think people are watching them. They're always kind of up for debate. How are they being marketed? Where are they being sold? So this one jumped out at me.
What's a flavored
You want a Philip Morris story?
Yeah.
Spring 1986, Richmond, Virginia. I was a senior at the University of Richmond interviewing with Philip Morris, who was based then in Richmond, Virginia, which is a tobacco town. Go to the interview, 3 people interviewing me. During the interview, they all lit up.
As one does.
See my reaction? My reaction was, I got up and left. Said,
you
thanks.
did?
Yeah, I said, no thanks.
So they were so they lit up in the meeting, and you just stood up and you're like, guys, I appreciate it, not interested.
See ya.
Get out of here. Oh my God, that is actually a really good story. And you think they did that on purpose to gauge the reaction to that?
Yes, and this was 86 before there was any of this anti-smoking stuff. And I was, raised on my mother's lap when she had a cigarette hanging out of her mouth.
Same.
Exactly.
Yeah.
But I was like, all right, I'm not doing it, and that was back in the 80s before there was this anti-smoking stuff.
Paul, ahead of his time.
I was ahead of Mr. Bloomberg, who was doing the anti-smoking thing. This was 1986.
And I remember when, restaurants were all smoking, and then they had the whole smoking, non-smoking thing, and you're like, really? It's all air.
And when you see movies, remember, you probably don't remember, smoking on airplanes.
Oh, I remember.
Wow, that is insane.
And you're thinking, this is gross. How did we let this happen? This is recycled air.
Exactly.
That is a good story. Carmen's got nothing. She's like, okay, guys, whatever. I'm moving on to...
I don't even know what you're talking about.
Fisker. So, this is a really interesting story,
Fisker has been so beaten up. Shares are down so much. It's, trading for pennies, but shares down 55%, or actually almost 60% right now. The company filed for bankruptcy. It's an electric vehicle startup. It's just had a lot of malfunctions with its Ocean SUV. The thing that I also thought was really interesting here is this is the second plug-in car company by the same founder, Henrik Fisker, that's declared bankruptcy, ended in bankruptcy. So it had an earlier venture that filed for Chapter 11 in 2013 after recalls.
I don't think I've ever. Have they produced any vehicles?
I think just they have this Ocean SUV, and it's just kind of continued to malfunction. But they
Never
also
seen it, yeah.
But keep in mind that Henrik Fisker designed BMW and Aston Martin sports cars.
Oh,
so he's
okay,
a car.
so
He's a
car
real
person.
car guy.
Okay.
I've interviewed him before. He's definitely a real car guy. But it definitely goes to the idea that this is just a really hard business to basically be in, particularly as it's really expensive and it's really hard. And plus, when you have software bugs and you have slowing production, that's also not going to be great for Fisker.
Also went public via a SPAC, so just another SPAC that has not gone particularly well.
It's kind of what Kevin Tynan, the Bloomberg Intelligence auto analyst, has been saying all along. At some point, all these companies with their technology, they got to start bending metal. They got to start making stuff and make a lot of it and make it to a certain quality level. That's hard. And I think a lot of those companies are figuring that out now.
Yeah, and I mean, to your point, they produced over 10,000 Oceans. That's their car last year. They only delivered almost 5,000, and they were trying to pivot. They were trying to go with franchise dealers in North America rather than the direct-to-consumer pitch, which is what Tesla has. Right. And that just didn't happen really fast enough. Anyway, thank you so much. We really appreciate it. Carmen Reinecke, who did not oversleep, joining us from Bloomberg News. All right, let's get to the bond market here. We have a little bit of a bid in the bond market. Yields are a little bit lower, particularly in the front end. That's after yesterday when yields were higher, and last week when you had the 10-year yield down 22 basis points on the week. Let's go to Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist, is joining us. What is moving the bond market now? We got through all the data. Now what?
Yeah, well, so obviously the retail sales data was the thing that was the impetus for today's rally. Before that, we came in and basically markets were just chopping around a little bit. The big data points are going to still be the catalyst for any major moves in the market, I think, from here. We do have some supply today. I know Alex, you're always very keen on talking about supply, and we have a 20-year bond auction today with the market closed tomorrow. It'll be interesting to see how many people want to take risk in that, because it's sometimes when you have these kind of days where there's not a lot of risk taking the day after, people kind of shun those auctions. So it'll be interesting to see, even though we have good momentum right now going into the auction, maybe people will kind of shun it because it's because they don't know if they'll be able to get out of that risk before day's end. So, meanwhile, it's going to be the Fed speak, right? We have a lot of Fed speakers, some people on the tape right now. There's going to be a bunch later, so those are potentially market moving as well. But it's not Powell, so I'm not sure that the market is going to, how seriously the market's going to take some of the speakers today.
Well, the Bloomberg News reporting on these retail sales says U.S. retail sales barely rose in May, and prior months were revised lower, pointing to greater financial strain among consumers. Ira, how does the Fed think about the consumer and the health of the consumer? Do they look at things like retail sales?
Yeah, absolutely. In fact, retail sales is one of the primary key drivers for the outlook for growth, because retail sales feeds into personal consumption. The issue with retail sales, when you look at something like GDP or the personal consumption report that we get in a couple of weeks, is that it does overweight the goods sector versus services. And obviously, services are such a major component of people's spending these days that retail sales are things like your Amazon sales. So I was looking at what they call non-store retailers, which is online, and the growth in those sectors from a sales perspective has been going down a little bit, or not rising as quickly as it had been. And I think part of that's just in part of what you're saying, Paul, that consumers are not in great shape because prices are so high, so they're not spending as much. But I think it also shows that that the prices just aren't going up as quickly, and retail sales had been growing much more quickly when prices were going like gangbusters, right? Because people still have things that they need to purchase, right? When you go out to buy food, or you go out to buy consumable goods, right? Even consumer products, toothpaste and the like, you're always going to buy those, and you're going to be reasonably price insensitive. So the price growth of those has slowed down pretty significantly. Look, the price of goods, CPI for goods was basically zero. And so when you look at retail sales not growing, that's also a sign that, hey, people aren't buying those things. But you look at services, people are still going out in droves. People are still want experiences, and that's where people are choosing to spend their money as opposed to goods and retail kind of activities.
So if I just sum that up, the retail sales number doesn't necessarily encapsulate all services. So to say, ooh, the consumer is slowing, or has slowed, may not be an accurate assessment. And also, slowing is not like falling off a cliff.
I think that's both correct. Yes, that's exactly right. Which is one of the reasons why we focus quite a lot on the personal consumption numbers that we get at the end of the month. I know it's like in the monthly cadence of data, it's relatively late, and it usually does follow the retail sales report. But the retail sales report is only about 40% of the consumption report that comes out with the personal income and spending numbers. So that personal spending data that we get, I think is, that will be a key indicator to me anyway, as to are we really seeing a slowing economy, or is there a substitution effect where people aren't buying, things to play with, but instead think people are going out and playing, right? That's, I think, one of the way to look at it.
So Ira, what's the next thing here that we should be focusing on here? I mean, you know me, I don't focus on those auction things. I just wait for your research to come out. What should I be looking at next?
Yeah, actually, the next week or so, it's kind of quiet.
Nice.
Other than
take some vacation days, dude.
Yeah, I wish I could. We're working on our second half outlook, so
okay.
That's going to be a big thing coming out next week that I'm sure you'll talk about with me next week, Paul. But basically that PCE number and the GDP report later this month will probably be the next big key data point that we'll look at. You'll always have Fed speak, right? We'll always have people Fed speakers coming on Bloomberg News or some of our competitors, and so that's always potentially market moving. But I think the incremental amount of information we're going to get from them that we didn't get from Powell is pretty small. We are looking out for when Jay Powell is going to testify before Congress in the semi-annual monetary policy testimony. We used to call that Humphrey Hawkins when that law was in effect. So that'll be probably be announced sometime in the next couple of weeks. The last couple of years, it's been in late June, but it has been in the past in early July, so not sure when that's going to be scheduled. But that could be the next really big key Fed speak that could move the Treasury yields quite a lot.
What is Euro 2024, and should I be paying attention to it?
Yeah, well, so Euro 2024 is the regional competition for national soccer teams in Europe. But, Paul, right here in the United States this year is a Copa America. Even more important, we have countries like Brazil and Argentina, Chile. The United States is in it, along with Mexico and Canada, basically a precursor to the 2026 World Cup. So it's going to be a nice warm-up where we have a very major competition with some great national teams in it that are going to be here in the U.S. The U.S. plays, we play Bolivia and Panama, and then we end up with Uruguay. So hopefully we get 6 points from the first two matches, because Uruguay is one of the better teams in South America for sure.
Of course they are. I mean, where can I see this? Is this going to be at the Meadowlands?
Yeah, so the finals will be at the Meadowlands. It's all over the country, but the U.S. is playing in Atlanta. I don't remember. I think they're playing somewhere in California, and then I think in Texas as well. So the U.S. unfortunately is not around here, so I won't be going to any of those games. But I know Chile, Argentina is going to be at MetLife. So some of my players from Real Central New Jersey are going up there on Friday night to go see them. They're both Chilean, so they're hoping for an upset there.
So this is what he's saving his vacation time for.
Yes,
like
exactly.
This is what this is.
Yeah,
then
exactly.
You can travel.
I go to the beach. He goes to like regional soccer games. So is Brazil the call here, and then Argentina?
Well, Argentina won the last World Cup, and their team isn't significantly different. So I think those are by far the two favorites. But Brazil does have some cracks in it. They're not the same kind of tiki-taka team that they used to be back in the days when they called it the beautiful game back in the late 90s. But yeah, those are the two powerhouses for sure. But Colombia has a very good team. Chile is always a dark horse. So I'd say that those four teams are probably not shoo-ins for the semifinals, but certainly odds-on favorites.
Sebastian writes in and says, correction, the final is in Miami, not New Jersey.
You can go to
my
that.
apologies. The World Cup finals in New Jersey. My apologies.
That's right,
about
exactly.
that.
See, I tell you, we talk global soccer, and people just kind of chime in here. They go crazy, so we got
Soccer,
that.
you play with your feet.
So really, it's football.
Yeah, exactly.
Which makes sense.
Yeah, it's football. And Ira's all over it with Real, Central New Jersey, minor league soccer. Ira's all over that stuff here. Ira Jersey, thanks so much for joining us. Ira Jersey, he is the chief U.S. interest rate strategist for Bloomberg Intelligence. I can't keep track of all the soccer matches. Like, what's the club stuff? What's the country stuff? But this is a country stuff, and so I pay attention to that.
Okay.
My team is the Netherlands.
Okay. But they're not playing in this thing that you're just talking about.
No, they're playing in the Euro 2024.
Okay.
So this is European countries. And then for, I guess, the Americas, we have Copa America, which I was talking about.
So why the Netherlands?
Because it's small. They got like 12 people in the country, and they have like some of the best soccer players in the world. I can't believe it, you know. So anyway, I was over there marketing one time, way back in the day, and I wore the orange tie, which is one of the colors of Holland. They loved me. So I've been a fan ever since.
Funnily enough, football is something that I will actually sit and watch.
There you go.
Like this one. Like
This
the
one.
one you actually play with your feet, not your hands.
Yes, exactly.
Which
Okay.
makes sense.
Very good. That makes sense.
We're going to talk about other stuff. You know, there'll be some soccer, but we'll talk to George Ferguson about Boeing from Bloomberg Intelligence. That's coming up next. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
the Bloomberg Interactive Broker Studio. I'm Lisa Mateo. We have little movement in stocks. This is after the S&P 500 and NASDAQ Composite both closed at records yesterday. Information technology, that was the S&P 500's best performing sector yesterday, with chip makers having a pretty good day. Broadcom led the way, but shares this morning, they're lower right now. Broadcom down about 1%. Today we see that shift from information technology. So if you look at the 11 major industry groups in the IMAP function, you see the most pull coming from energy. A little further, we see oil and gas, then integrated oil and gas, and finally at the top we see Exxon, followed by Chevron. We have Exxon right now up nearly 2%, Chevron up about 1.5%. Turning to earnings, shares of Lennar lower this morning, down nearly 3%. The company posted profit that was bigger than expected, but the problem is that investors didn't like that order's forecast for the current quarter, while they fell short of estimates. And news from EV startup Fisker, the company has filed for bankruptcy. This is after talks with a major automaker about an investment. Well, that ended without a deal. Ending with the bond market, the 2-year yield 4.72%. That's down 4 basis points. The yield on the 10-year 4.26%, down 2 basis points. That's your Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa Mateo. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business and finance through our lens of our analysts over Bloomberg Intelligence. They cover 2,000 companies and 130 industries worldwide. And joining us, speaking of, is George Ferguson. He's Senior Aerospace, Defense, and Airlines Analyst at Bloomberg Intelligence, and he joins us from Princeton, New York, our BI headquarters over there.
Princeton, New Jersey.
In New Jersey. What did I say?
Princeton, New York.
I did?
Yeah.
Sorry.
Coffee.
I haven't had that second cup because it was delayed. I'll get you. The 11 o'clock hour will be a good hour for me. So Boeing is having a lot of issues. The CEO will be facing leaders in Congress today. There was also latest whistleblower report that alleged that the plane maker mishandled and lost track of hundreds of faulty parts, some of which may have been installed in some new 737 MAX planes. George, there's so many questions, but what is Dave Calhoun today going to face from Congress, and then in the light of these consistent whistleblower claims?
So my guess is that what Dave Calhoun's going to say today, he's going to stick to the script. He's going to say they're working on fixing all these problems. He'll probably not be able to confirm or deny sort of individual reports. We saw the report come out, that Boeing, they gave us a summary of what they provided to the FAA on their action plan, for improving the production process. It included things like, making sure they appropriately tracked faulty parts and didn't put them in airplanes. So my guess is there were some situations where this was a problem. But again, I think he's not going to give a lot of specifics today in front of Congress. I think it's he'll stick to the script, and there's a plan out to fix it, and he'll say we got the plan, and we're going to drive on that plan.
Hey, George, I know from speaking to you in the past and reading some of your research, one of the challenges as it relates to quality is outsourcing. Boeing over the last number of years, 10, 20 years, has maybe outsourced a little bit more of their production, their parts, and so on to third parties, and that may be introducing some more risk into their process. How are they talking about some of their outsourcing strategies?
So in that same report, right, they talk about inspections at suppliers. They talk about monitoring quality at suppliers better. Yeah, I just think this is it's a wholly different industry, right? I think there's a bunch of people that have come to the aerospace world from auto backgrounds and other mass production backgrounds, right? And in those worlds, safety isn't as important. Volume is a lot higher. You can get multiple suppliers to provide products to your production line. You can work cost on those suppliers. And I think that whole game plan is really, really difficult to do in aviation. And I think this is part of what we're seeing, right? I think you can outsource, but I think if you outsource, to your supplier base, I think it's still got to be a pretty strong relationship with them, not a combative relationship where it's always about price, because it really matters the quality you get to your line, right? Safety's dependent upon it. And so I think what we're finding out as this sort of whole Boeing saga unravels is outsourcing and banging up your suppliers for price just isn't a winning strategy in aviation.
Have they course corrected enough, or can they?
So, look, I think they can. Everything can be fixed. I think if you look at their competitors across the pond, Airbus, they're not having these problems. I think Airbus has been less combative with some of their suppliers. They're in the middle of this correction. We know they want to buy Spirit Aerosystems. We're still waiting to hear news on that. There's still, the challenge of getting some of the other companies that Spirit supplies to, namely Airbus, probably out of the portfolio. So they can recover. It's gonna take some time, and it's gonna take a lot of work with our suppliers.
So, George, if I think about, rethinking my strategy with my suppliers and maybe focusing less on price competitiveness, maybe a little bit more on quality, does that imply that Boeing's profit margins will be under pressure going forward?
Yeah, I mean, I think for sure, right? I think you're not going to see a return to the Boeing margins you saw at the end of last decade. I'm not going to say ever. Like in time, perhaps they could get back to that. But I think it takes, it's going to take a bunch of work here near term to improve the quality, and that's going to cost money. Plus, we already know that some of the business they put in the books, right? They had some challenges delivering into China. That was kind of the 1-2 whammy after they had the grounding of the MAX and the crashes. We know they probably sold a bunch of airplanes for some pretty good prices to really core customers like United, like Southwest. So I think both on the cost side, again, given this correction to improve the supply base, improve production, get capacity rolling again, as well as some of the pricing they gave away on backfill for orders, means you're not looking at a Boeing that's going to get those margins for you through this decade, I think.
If I look at Boeing stock then, I mean, it's down from December. It's down 34%. Does that accurately reflect then this tighter profit margin world, the sort of revamp and the course correcting that they have to do?
So, I think when you look at their valuations, their historical valuations, one, they're really high right now, right, because earnings are so low. So I think that there is a little bit of investor look through at this point, on the current problems they have. But the sort of whether or not they're properly positioned for the out years right now, I think it's all a function of if they can quickly improve the build rate so they can improve economies of scale and start to get more profitability back into this business, and that really remains to be seen.
George, you mentioned China. Where is Boeing in terms of getting the 737 MAX in the air in China? Kind of how's that business looking in terms of sales and deliveries?
So their deliveries going into China, right? And it looks to us to largely be deliveries that were, built, when the 737 was grounded, and they're starting to get some of those back into the country. But China's also has this problem now with the flight recorder that's been, authorized by other jurisdictions, including the U.S. So, I mean, it feels to me like China's allowing deliveries, but they still, they're still not, I don't know, maybe keen on taking a lot of deliveries from Boeing. I haven't seen a bunch of orders come in from China, for Boeing. And so I would say that relationship still, while it's maybe thawing a bit, is nowhere near where it was in the last decade. And they have their problems too right now. I think they don't need as many airplanes. Their economy isn't growing as fast. Air travel isn't growing as fast. But I still think that relationship is not in the right place where it should be, where you'd like it to be, I think, for Boeing.
Before we let you go, any word yet on a replacement for Dave Calhoun? Like, how's that going? He laughed. His answer is laughing.
Yes.
What I hear from news reports is it's picking up steam, but gee, I mean, I don't know, it's been a while. There's a lot of conjecture. It's a hard job. There's probably a lot of people that just aren't willing to take it. I don't know, they got to the end of the year, and so maybe they're going to use it all. I don't know.
I mean, and anyone but Larry Culp that you keep hearing about that's for real?
So I don't really track the people. That's kind of hard for me.
Okay.
I do know, like it said, there's got to be a rock star manufacturing, sort of CEO. I don't know that there's a lot of them left in America. I think we do a lot of outsourcing now, so maybe that makes it a taller order too. I don't know.
All right. Hey, George, I really appreciate it. George Ferguson, Bloomberg Intelligence, Senior Aerospace, Defense, and Airlines Analyst, joining us from Princeton, New Jersey.
Yes.
Who would have thunk?
Yeah.
It was in New Jersey and not New York.
Lovely.
Just kidding. I knew
Home
that.
of Hoagie Haven, my favorite sandwich shop on
Just
the
still
planet.
waking up on that.
Yeah. Boeing down 2% today, down 33% year to date. It just feels like a stock. No one wants to step in and really take a big position here until you see real signs of a turnaround. Because it just feels like every day there's something coming out.
And if you just time it out, right? Like, say they do take the rest of the year to get a new CEO. Like, let's just game that out for a second. Then the new CEO has to come in, right? Then it's a plan. Then it's going to be some kind of restructuring plan in that, like, how we're going to manage the business, how we're dealing with suppliers. And then if they do wind up buying Spirit Aerospace, then you got to integrate that. I mean, how long of a process is that?
Yep, exactly. So, I mean, and is there a value here where it just says, I'm being compensated for that risk and that time? And I don't know, and it just doesn't feel like it. Again, stock down 33% year to date. So.
And it's still trading at, where are we here? We're trading at...
well, it's tough because they really
they're not really trading at anything. It's hard to say that. But
it's multiple of EBITDA, so.
Right, so it's hard to even know what we're doing. All right, let's go to Michael Barr with World and National News. Michael.
Thank you very much, Alex, Paul, Lisa. Former President Trump's bid to eliminate taxes on tipped work could impact the federal budget deficit. We get the details from Bloomberg's Jody Schneider in Washington.
We got an estimate from the Nonpartisan Committee for a Responsible Federal Budget, which suggests that its impact would be, the plan's deficit impact could be as much as 150 to 250 billion that it would add to the federal budget deficit over 10 years. This, of course, is this tax exemption for tips is former President Trump's latest effort to court younger voters. He announced it at a campaign rally in Nevada, which is a swing state, a crucial battleground state, which has the highest proportion of food service and hotel workers in the country.
Bloomberg's Jody Snyder in the nation's capital. President Joe Biden is planning to announce a sweeping new policy that would lift the threat of deportation for tens of thousands of people married to U.S. citizens. The policy will allow roughly 490,000 spouses of U.S. citizens an opportunity to apply for a parole-in-place program, which would shield them from deportations and offer them work permits. Officials say firefighters have increased their containment of a large wildfire that is threatening critical infrastructure in mountains north of Los Angeles. Hot, dry, windy weather forecast for today could pose challenges. The post-fire is 20% contained. There is news about Justin Timberlake.
As long as I got my suit and tie.
The singer was arrested and is accused of driving while intoxicated on New York's Long Island. A law enforcement official told the Associated Press Timberlake was expected to be arraigned later today in Sag Harbor on the eastern end of Long Island. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We have little movement in stocks this morning. Right now, we have the S&P 500 up about 0.1%, 7 points at 5,481. The Dow, little changed, up about a point at 38,778. And we have the NASDAQ, little change, up about 7 points at 17,864. Over to the bond market, we have the 2-year yield, 4.72%. That's down 4 basis points. The yield on the 10-year, 4.24%, and that's down 3 basis points. We'll head over to commodities. We have spot gold. That's higher at $2,324 an ounce. Brent crude, $84 a barrel. We have WTI crude at $81 a barrel. Looking at currencies right now, the dollar weaker, Japanese yen weaker. We have euro, British pound stronger. We have Bitcoin down about 2% at 65,000. Companies making news, a lot of them linked to Elon Musk. Reuters reporting Elon Musk telling his staff at Tesla the company's working on offering stock-based compensation for its top-performing employees. Tesla shares down about 2%. Now, on top of that news, documents show Musk also planning a Venmo-like payments feature for his social media platform X nationwide. That is your Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa Mateo. One other stock we're watching is Lennar, down by almost 3%. So this is a home builder, and it forecasted that deals in the third quarter missed consensus expectations. And then Barclays pointed out that if you take a look at their fourth quarter guidance, it implies a very large ramp up in gross margins in that quarter. And investors are a little skeptical as to whether or not that actually is going to happen. So no one to turn to but Drew Redding, Bloomberg Intelligence home builder analyst. He joins us now from Princeton, New Jersey. Hey, Drew, I don't know. I thought it was all like we don't have enough supply. This is bullish for builders. So what happened?
Well, I think you framed it perfectly. The story with Lennar and why the stock's down isn't so much about what's happening with the volumes. They delivered good orders. They're up 19%. They maintained their full year guidance for 80,000 home closings. It has to do with their outlook for gross margin. They guided to about 100 basis points below what the street was looking for. And as you mentioned, that would require a ramp in the fourth quarter to about 25%. So like you said, there's definitely some skepticism in their ability to meet their full year outlook. The reason for that is because we saw rates move up as high as 7.5% during the quarter. You know, they've come back in a little bit, but we're seeing their need to incentivize buyers remain elevated, and that's what's impacting profitability.
So where are we in that activity there? If I'm looking at a 7% mortgage, what are they going to do for me?
Yeah, so typically what we're seeing is that the builders will maintain a spread versus the headline rate. So if you're seeing 7.5% in the market, typically you're going to get 6% from a builder. There are some other builders, and depending on the market, depending on how strong the market is, what demand looks like, they could get you into the 5s. But obviously that's going to cost them on the gross margin line. So the incentives they're using are certainly working. It's just what's the cost.
Mm-hmm. So that 100%, the 100 basis point miss, but then keeping their guidance for gross margin for the year, that must imply that they're looking for rate cuts.
Yeah, I think a lot of it has to do with what they're doing on the cost side. One of Lennar's emphasis for their business over the last several years has really been running a more efficient manufacturing-based business where they're not necessarily just chasing volume, but they're doing it the right way. They're fine-tuning their floor plans. They're pushing back on their suppliers. You have to remember, they're one of the second largest builder in the country, but they're one of the only builders who has scale at the national level. So they're able to leverage that and kind of push back a little bit. So certainly some of the benefit that they expect in 4Q, I would assume, is going to come from what they're doing on the cost side, as well as fixed leverage from higher deliveries. But nonetheless, that's still going to be the focal point for investors, is how do they get there?
How much, I remember this back in the beginning of the pandemic, lumber went crazy. Mm-hmm. Where are we in lumber, and how was that a part of their gross margin?
Sure. So lumber is about 10% of the COGS for a builder. So it's certainly the most important input cost, as you would expect. Lumber prices have come back down a lot. So builders have been benefiting on the margin side. I think we've seen more stabilization of late, perhaps a little rise to the upside, but really lumber is not impacting the business in as significant a way as it was over the last couple of years.
So KB Home reports after the bell today, right? So what kind of company is KB Home versus Lennar, and how does that set up KB Home for today?
Sure. So KB is predominantly focused on the entry-level business. It's about 50% or more of their total sales. So in addition to just focus on broadly on the entry level, we look at what they're doing from an ASP perspective to get a more holistic look. And they're actually one of the more affordably priced builders, particularly when you compare them to the resale market and against, you know, their public peers. So I think from a pricing perspective, they're pretty well positioned. So they'll give us a good sense of what's happening on the lower end of the market. With that being said, as you would expect, entry-level buyers are much more price sensitive. They're more sensitive to that monthly payment and what's happening with rates. And we saw that earlier with a low-end builder, LGI Homes, who's looking to take buyers out of a rental situation and put them into a home. And we saw relative weakness there. I think what you see from some of the other builders is maybe a little bit more of a higher end entry-level buyer, maybe dual income, who's waited a little longer to purchase. So there still has been relative strength, but we'll get a good read on that buyer today.
What do the companies tell you about their expectations for interest rates, mortgage rates? What do they think is going to happen?
So I think the expectation broadly is that mortgage rates will start to come in a little bit as we get through the end of the year. I don't think they're managing their business for any, you know, significant drop in rates back to, you know, where we were previously. But I think as a builder, from a demand perspective, if we get rates coming back to the 6.5% range, you know, that's pretty much a sweet spot for them. You know, we've heard that as you get to 5.5%, that's really when demand in the market starts to move. So the fact that if we could get to 6.5, they're buying down rates 100 basis points, I think they'll continue to do well. And, you know, what's interesting is the public builders are kind of at the top of the food chain as it comes to housing. You have to realize they're generating about 50% market share compared to, call it 38% prior to the pandemic.
Really?
Wow. So they've really leveraged that lack of inventory in the resale market and the struggles among some of the smaller private peers, and they've capitalized on it.
So when you say we have to, the 5.5% is kind of a nice sweet spot, so that implies the Fed funds rate at 6.5% and the home builders still give that 100 basis point discount. When the Fed funds rate gets to 5.5%, do the builders still offer that 100 basis point discount?
I think it's going to depend on what the broader macroeconomic situation looks like. If we get a pullback in rates, you know, a modest pullback, and we are still dealing with a pretty solid labor market, I think that, you know, builders will be able to definitely pull back on their use of incentives. I don't know that they'll go away altogether, because at this point, it's something that buyers are looking to, and it certainly made their product more attractive. If we get a significant pullback in rates, and it's because, you know, the economic situation has deteriorated further, that's obviously more of a concern, and we would see them probably push incentives even harder.
What kind of homes are builders building these days, Drew? Is it the McMansion where they can get the big profit margin, or are they building what the market actually needs, which is some of these entry-level homes?
Yeah, that's a great question. And we've seen one of the primary ways that builders are addressing the affordability equation is through smaller square footage floor plans. It's a shift most of them have done. We've seen it over the last couple of years, more targeted towards the entry level. Interestingly enough, you even have someone like a Toll Brothers, who you traditionally think of as that luxury builder within the builder space. They've shifted to what they call affordable luxury. Now, it's still not something that the masses are going to be able to afford, but it's certainly a lower price point that, as I said before, is attracting those more well-heeled dual income buyers. So every builder has kind of attacked affordability in a different way, but I think square footage has been something consistent across the group.
We only have about like 45 seconds left, but what's a builder that's kind of pulling on all levers correctly right now?
I think Lennar is actually an interesting case, and while the guidance may have disappointed a little bit, they're really delivering on what they said they're going to do. They're focused on price over pace, and they're willing to sacrifice a little bit of gross margin to do so. And the idea is that they're going to generate a ton of cash that they can use to pay down debt and return cash to shareholders, which is something investors obviously like.
All right. Hey, Drew, really appreciate it. Really great stuff. Drew Redding of Bloomberg Intelligence joining us on Lennar's earnings. Also, KB Home reporting after the closing bell today. That stock is down by 1.4%, obviously dragged lower by Lennar as well. They're looking for a deliveries estimate about 3,400 homes, looking at a revenue estimate about $1.66 billion and net orders about 3,900. Also taking a look at that backlog as well. All right, much more coming up on Bloomberg Intelligence. You're looking at a market that really is going nowhere pretty fast. You're seeing a little bit of rally in bonds. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Shares of online education platform Chegg on the rise. This after announcing a plan to cut 23% of its global workforce and a growth plan that includes a push into AI. Bloomberg's Abigail Doolittle says there's a lot of things to point out about this stock.
First of all, a lot of people into today probably had never heard about Chegg. Second of all, yesterday, Chegg was at an all-time record low, having been down 7 days in a row. Third, this is a penny stock. In 2021, it was a greater than $100 stock. So the fortunes for Chegg into this big surge have not been so great, in part because profitability was much more significant in 2021 when they put up 57 cents per share.
Shares right now up about 13%. Now, another company who's been riding high on that AI flight is Broadcom. The stock on track for its longest streak of the year, but shares taking a bit of a turn this morning. Bloomberg's Emily Grafeo says despite that, the stock has really been on fire.
Adding $200 billion in market cap just over the last week or so. The chip supplier supplies products for big tech companies like Apple, and it offers a range of components that are used in computing and networking.
And their shares down more than 1.5%. Best Buy getting ready for a big AI push. The company says it's trained more than 30,000 employees so far to sell and repair Microsoft's new AI Windows laptops. They go on sale today. Best Buy up about 0.6%. 1%. And shares of Boeing, they are lower, down about 2%. Its CEO Dave Calhoun faces that very public grilling from U.S. senators accusing Boeing of putting profit before safety. And finally, shares of space systems company Rocket Lab, well, they're getting a bit of a lift. They're up about 11% after announcing its largest Electron launch agreement in the firm's history. That is your company news at this hour. I'm Lisa Mateo, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Tuesday, everybody. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business and finance through our lens of our Bloomberg Intelligence analysts. They cover about 2,000 companies in 130 industries worldwide. We're broadcasting to you live from our Interactive Broker studio right here in a very hot Midtown in Manhattan. We also keep you up to date with world and national news, and for that, we go to Michael Barr. Michael?
Thank you very much, Alex. Paul, Lisa. President Biden will sign an executive order today that would offer legal residency to undocumented spouses or children of U.S. citizens who've been in the country for at least a decade without requiring them to leave the country first. Bloomberg's Jody Schneider has more from Washington.
That's a big change because currently the situation is they must depart the U.S. sometimes for years before they can be eligible to apply for permanent residency as well as work permits. So this is something that has been discussed for years. It was discussed in the Obama administration, and now President Biden plans to roll this out at a White House event today that's commemorating the anniversary of the Obama-era DACA program, Deferred Action for Childhood Arrivals program.
Bloomberg's Jody Schneider reports this order comes 2 weeks after President Biden's executive action to limit asylum claims at the southern border. An early summer heat wave is impacting tens of millions of people stretching from eastern Iowa into New England. In Worcester, Massachusetts, public schools are ending the term early because of the heat wave. Boston Mayor Michelle Wu is preparing the city's public schools.
We are planning to declare a heat emergency Tuesday through Thursday. There are about 10 schools that don't have air conditioning in the building.
In New York City, Mayor Eric Adams says the excessive humidity will make it feel even more oppressive. A law enforcement official told the Associated Press that singer Justin Timberlake has been arrested and is accused of driving while intoxicated on New York's Long Island. The official said Timberlake was expected to be arraigned later today in Sag Harbor on the eastern end of Long Island. British stage and screen star Ian McKellen is recovering. He was acting in a fight scene in a London theater when he apparently lost his footing and fell off the stage. The play was halted and the theater evacuated as 2 doctors in the audience rushed to his aid. The theater says the 85-year-old is expected to make a speedy recovery and should be back on stage in a day or 2. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Paul, Alex, and now Charlie.
I read that Ian McKellen story and my heart jumped into my mouth. Oh my gosh. As an ex-theater person, oh my God, as a stage manager watching that happen, it was like your whole life probably flashed before your eyes. Yeah. Okay, so here's an interesting story. It's a little complicated, but there are websites here in New York like Appointment Trader, where you can go and buy reservations to some of the city's hottest dining spots. You got to pay for it. So basically, these appointment traders, they get the restaurant appointment, and then they sell it to you because it's very hard to get into places from Carbone and lots of other restaurants that I can't pronounce. But now New York City is trying to clamp down on that. New York City has a proposal, a Restaurant Reservation Anti-Piracy Act. And that would clamp down on places like Appointment Trader and Sitta, who also does the same thing. They may not be able to advertise these hot tables. Resi and Open Table, they're fine because they have a deal directly with the restaurant.
So if I'm a restaurant, do I want my reservations going to these third parties who then resell them?
I don't know.
Or do I care?
I mean,
I'm not sure I care.
Why would you care?
I don't think I would care, other than somebody's making money off of my intellectual property, my restaurant, my whatever.
I think also, Resi and Open Table, I think that they charge restaurants directly to a monthly fee. So then if you have another website that doesn't pay, that you don't have to pay, is that a good thing or a bad thing? I don't know.
I do use Resi and Open Table, and it's helpful.
So Open Table doesn't let me because I've not shown up for so many reservations, so I'm banned from Open Table.
Is that right?
Yes.
Wow.
So I only do resi. But I guess the bigger
Now,
question...
is this just because I forgot about the reservation, or I just...
I don't know.
Man, I did.
This was like, I
That's a
need an
new side.
assistant and I don't have one.
Okay.
Yeah. But apparently, you may not be able to get a reservation for $1,000 anymore. Too bad. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with Vince Signorella. He's our market strategist at Bloomberg News, get a sense of what's happening out there in these markets. He talks to the traders all day, see what we're hearing from the trading desk. Joe Blanchard, president of Enterprise Client Solutions at Advantage Solutions, a lot of solutions there, joins to discuss U.S. retail sales. Came in a little bit weaker than expected. And this next one, I'm not sure we want to go there. I might just let Alex deal with this. Amesh Adalja, senior scholar, assistant professor at Johns Hopkins University on, get this, what to know about the flesh-eating bacteria spreading in Japan.
Okay, I read this yesterday and I fled from this article.
Yes, I know,
so I'm
but
so glad we're gonna
it's
talk
a
about
thing.
it.
And we talked to Amesh Adalja during the pandemic, one of the smarter folks that we spoke to during the pandemic. We all got educated about the coronavirus and all that kind of stuff. But right now, let's kick everything off with Mr. Charlie Pellet.
Dow Industrials down 43, dropped there of 0.1%. S&P little changed, up 3, up by about 0.1%, while NASDAQ lower by 11, down 0.1%. 10-year 4.24% with a 2-year 4.71%. Gold up 0.2%, 23.23 the ounce, and West Texas Intermediate crude oil up 1.2%, now at 81.34 a barrel. A rally that drove stocks to records, wavering somewhat today as traders weigh mixed economic data for clues about the outlook for Federal Reserve policy. Among those reports, retail sales, they barely rose in May. Prior months revised lower, pointing to greater financial strain among consumers. Greg Dacco is chief economist at EY.
I think what they indicate is an environment where you're seeing a bit of a more caution, more prudence on the part of consumers. And this is not new. We've been seeing consumers be a little bit more careful, be a little bit more sensitive to higher prices. This cost fatigue that we've been talking about for a few months now is now starting to be visible in the data.
Taco was interviewed this morning on Bloomberg Television. After earnings, we got Lazy Boy shares surging 17.5%. Homebuilder Lennar after earnings down 2.5%. Recapping a mixed Tuesday, S&P up 3, now a gain there of 0.1%. Both the Dow and NASDAQ are trading lower. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. I'm Alex Steele alongside Paul Sweeney. Happy Tuesday, everybody. Let's get to the market because overall it's pretty boring, but there's some individual stocks making some very big moves. I mean, Micron continues to surprise to the upside here ahead of earnings next week. You also have Qualcomm doing fairly well. Dell continues to do well. I mean, all the usual suspects continue to climb higher. Vincent Signorella is Bloomberg macro strategist for Bloomberg News, and he joins us now. Hey, Vince, what kind of companies, what are you looking at today?
You know, I'm still watching that potential rebalancing of the tech ETF, and it does look like some of it's going on. NVIDIA is up today. It's worth about 7 points for the S&P at the moment, up about 1.75%, and a lot of the other majors are lower. Microsoft, Apple, Meta, Amazon, Broadcom, Tesla, all much lower. So NVIDIA seems to be holding up the S&P, which is the only major average in the green at the moment.
So just to clarify for our audience, that there's ETF rebalancing on Friday. One of them is a State Street tech ETF, and there was a great piece out yesterday that talked about how that might mean you'd see like $10 billion of buying in NVIDIA in terms of shares and selling about $12 billion in Apple as it has to rebalance. Maybe that's what you're talking about, right?
Yeah, that's correct. The setup going into last Friday when the ETF was rebalanced, or the rankings, I should say, were set. were that Apple and NVIDIA would switch places in the number 2 and the 3 slot. The number 2 position has 22% of the ETF. The number 3 slot, only 6%. So when they switch places, NVIDIA shares needed to be purchased to go from 6 to 22% of the ETF. And the converse for Apple, sales of Apple shares to reduce its balance in the ETF from 22% to 6%. It doesn't look like that huge amount is going through when you're talking about between 10 and 12 billion, but it is interesting to watch them trading with NVIDIA to the plus side, Apple to the downside. So I think there's something to it. Some of it is going through. It's going to be interesting to see how they trade, both of them after Friday when the rebalancing is done.
Vince, how concerned, if at all, are traders that you talk to that, you know, there's a real concentration in this market, whether it's Magnificent Seven or however you want to frame it. There's maybe not as much breadth as a lot of market technicians would like to see. Do you hear that concern from traders?
Oh, yeah, all day long. You know, and what you guys know is I squawk and I talk to traders. And, you know, whatever I may say, like, for instance, if I say something like, the Dow's gone into the red, I'll get instant messages basically like, no one cares about the Dow, just talk about NVIDIA all day long. And it's insane about how it's so much is focused in just a handful of stocks. And it's a little scary when you look at it. I mean, everybody's going into AI. And the Spectator Index had an interesting tweet this morning. It said that ChatGPT produces incorrect answers over 50% of the time, according to researchers at Purdue University, when asked on 517 programming questions. So if that's the extent of AI that we're putting all this money into, it's a little scary because it's in such a new place. There's so much more to learn and so much more to do for this to get to a place where it's quantifiable outside of NVIDIA, of course.
All right, Vince, we really appreciate it. We gotta leave it there. But it's a great point, and that gap between, say, even the NASDAQ 100 and the equal-weighted NASDAQ, right? The S&P and the equal-weighted S&P. I mean, all of that gap is really quite staggering. We appreciate you, Vincent Signorella, a Bloomberg macro strategist for Bloomberg. All right, coming up, we're gonna talk to Jill Blanchard. She is president of Enterprise Client Solutions at Advantage Solutions, and we're gonna get the take here on retail sales. So retail sales barely did anything, and the narrative here is that the consumer is strained, that they're going to buy stuff, but they're going to buy it on sale. The rub here is that this is mostly a goods report versus what we're going to get when we get consumer spending a little later in the month, where that might be actually a services report. So there's still questions as to what the real read-through is for the consumer. Jill, what are your thoughts?
Yes, so hello, and thanks for having me back. Yeah, you know, I think I'd lead off with one big word, and that word is cumulative. And so the effect of inflation, the slow rise in income, the high interest rates are really having finally a cumulative effect on the consumer. And it's a really big impact. There's a big difference between inflation and affordability, as well as inflation and high prices. And so as consumers try to get used to high prices, if wages aren't keeping pace, and they're not, it creates a pretty big gap and drives very different behavior. So you mentioned promotions before. Consumers are really doing a lot of different things. They're still spending, but they are price conscious, they're creative, they're selective. They are, and I'm just going to walk through like a myriad of strategies. They're delaying purchases. They're trading down, whether that's a brand or a retailer or a product or experience. They're shopping promotions. They're price shopping across retailers. So instead of that consolidated trip, they're going to multiple retailers. They are cutting out or reducing discretionary spending. They're looking for larger size products that have a more economical value. They are sharing bulk grocery shopping. A third of consumers are now doing that. A quarter of consumers are skipping meals and buying unhealthier options because of high prices. So it's a lot of different strategies that we're seeing come to play.
I don't know if we have any data to back this up, or when do consumers get used to this new price level? Is it because it seems like we've been here for a few years, and when do we get used to it?
Yeah, that's interesting. So I'd say it's a tale of two economies right now. And so at the macro level, we're seeing it flatten out. But when you really get underneath that, healthier income households, are do have a healthy spend. They're driving demand, but it's balanced out by low and mid-income households that are curbing their spending. Now that split spending, that's a shift from what we've seen over the past couple of years, because spending was really fueled by pandemic era benefits, stockpile savings, the cessation of student loan repayments, a rapid wage increase. And so a number of things that are either reduced or actually eliminated now, creating a bifurcation in spending amongst income households.
Mm-hmm. When we take a look at the spending problem, how do we understand it? Because slowing versus falling off a cliff are different, and they're going to have different reaction functions for the Fed. What's the best kind of description?
Slow. I mean, nothing's going to happen fast, right? I'd say there's two things to consider. One is spending is never going to take a sharp turn in either direction. It's going to slowly turn in either direction. And there are multiple factors influencing that, like the reduction in the pandemic era benefits and stockpile savings, as well as, higher prices, as well as lower wage increases right now, interest rates. So there's so many things that really affect it. I think that we can, continue to expect to see things happen slowly over time, and not be surprised by what it is that we're seeing today. It's been building to this for many, many months.
Cicadas.
Oh, what?
Talk to us about cicadas.
I will talk to you about cicadas. So here's something interesting, and this is, partly about cicadas, and I happen to live in the cicada part of the country. It's brutal out there.
Is it really?
It's like The Shining. So here's the thing. We've talked about inflation. We've talked about the slow rise in income, the high interest rates. Let's talk about the effect on retail spending of extreme weather, which I know we've talked about before. We saw today that there's going to be record-breaking temperatures in the Midwest and the Northeast. So it's extreme heat, it's flooding, it's fires, it's hurricanes, snowstorms, tornadoes. All of those things curb outside of the home activities, which are typically associated with bigger ticket spending. So think of things like going to an amusement park or a concert versus watching Netflix, going to a lake house for the weekend versus staying home, going out to dinner versus staying home. So the curb on out of the home activities will translate into a different and a less retail spend. So that's somewhat having to do with cicadas. I stay in because it is like The Shining.
Really?
That is horrifying.
Where are you, Jill? Where is this happening?
I am home based in the Chicago market. They're pretty brutal.
Interesting.
Oh man, I didn't even think about the cicada
So we don't have
point.
Cicadas here, do we?
No, we do.
We do?
Yeah.
I haven't seen them.
No, I mean not yet, but they're definitely going to come. Yeah.
Okay.
But to your point about extreme temperatures too, because then you stay home and guess what? You pump the air conditioner, because if you don't, you're dealing with 100-degree heat, and that is a huge bill. I mean, already my electricity bill has jumped by 2 just for May, and it wasn't even that hot. So that's going to be another impact as well. Yeah.
As well as think about the damage that comes from a flood or hurricane, tornado. So yeah, it really drives dollars being spent elsewhere, as well as the fact that it curbs outside the home spending.
You talk about then in terms of how loyal people are to brands. Like, is it just going to be a pure value trade? Like the lowest price that you can give me is what I'm going to buy, or do you feel like it's going to be very selective and brand loyalty matters?
So I heard somebody call this right now, and I thought it was pretty clever, that we're entering into the era of brand promiscuity, where we are essentially buying short-term loyalty, but we're really creating long-term disloyalty. So all those promotions buy today, but they sacrifice tomorrow. Having said that, I'd say that retailers are looking at a number of strategies. So it's not just promotions. It's their amping up their loyalty programs, their digital offers, their private label offerings. And let's talk a little bit about everyday price, right? So Walmart and Target publicly said that they plan to reduce the everyday price on thousands of items. This is a great trip-driving strategy to get the consumer into their stores, especially the consumers that are struggling to buy the basics every day. And it's a real shift in what we've seen over the past 2 to 3 years, and it might mark the beginning of a price war, the likes of which we haven't seen since inflation took hold.
So, what are retailers trying to do here? I mean, are they trying to keep customers? Are they just looking out for their own margins? What are retailers' strategy here?
Yes and yes, and maybe a few more yeses. It is less today about a pie that's growing, and it's more about stealing share versus creating demand. So somebody's win is somebody's loss. Again, it could be a brand, a retailer, or a product choice. And so retailers, are trying to get purchases and consumers that they might not normally get and or have recently lost. One of the things that we're seeing now that's really interesting is both manufacturers and retailers trying to sell, call it non-traditional products and non-traditional outlets. And so you could expect to see health and beauty care products at a Dick's Sporting Good, maybe some more food products at a TJ Maxx. And so they're really trying to get new avenues of distribution to get those consumers in store. A flip version of that is if you look at the dollar channel has traditionally owned that lower price point or that opening price point, but so many other retailers are now entering into the smaller pack sizes for that opening price point and really getting that volume from the dollar stores.
Wow, that's really interesting. It's true. As a frequent user of TJ Maxx, I do notice that there is more packaged foods. The home goods store, oh my God, it's everywhere. Like half of it feels like it's food now. Just to wrap this conversation up as we go to sort of the Fed, let's just pretend the Fed cuts 1 or 2 times this year. They say 1, market says 2. Does that matter for the consumers that we are talking about? Does that materially change kind of what they buy and how they spend?
Long term, yes. Near in, not as much as we would think. It will have a little bit of an effect, but again, cumulative is really the word of the day here, and that it takes a while for any of these effects to catch up to the consumer. So what we're seeing today is the effect of what's been happening over the past 12 to 24 months. And so it will have an effect, but not as big of an effect near in.
Hey, Joe, thanks so much for joining us there. Really appreciate it. Joe Blanchard, President of Enterprise Client Solutions at Advantage Solutions, on Zoom from cicada-infested Illinois. Who knew?
I
guess it's coming our way.
I mean, like the Shining example doesn't feel so, that feels a little scary.
No. I'm looking at an article here today about Citigroup. They're having an analyst meeting at their headquarters, presumably downtown, 388 Greenwich Street. Chief Executive Officer Jane Fraser, Chief Financial Officer Mark Mason. Going to be talking about one of the businesses that they've been in for a long time. And I worked at Citi and didn't even know this business, but it's really the backbones of global commerce, moving all the money around and the currencies and the this and all the back office stuff. They call it the services business. It's become, one of their bigger business and most reliable profit contributors. But most people don't even know about it, think about it. We think about, the lending part of the business, the investment banking part of the business, the consumer part of the business, but the services business, which supports companies and corporations all over the world with a lot of their back office financing needs. That's a huge business for them, so they're trying to highlight that today. I'm looking at Citi, the stock's up 1.5% today, up about 18% year to date.
And apparently, it is kind of like the pipes and the plumbing of the financial system, but they don't want that to be used anymore to describe this part of the business. I think they're trying to elevate it in a different kind of way. And I have a Bloomberg correction. We will not see cicadas in 2024.
Oh, we won't?
I mean, there are areas in the state, but New York, maybe not. Immediately south of Syracuse, you will. My mistake.
Okay.
But I remember cicadas at some point, but maybe that was just
we
me.
had a few years ago.
Right? This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long at Bloomberg. We are looking at a mixed U.S. stock market right now, with the Dow, NASDAQ lower, S&P higher, little changed. Right now up another 2 points, climbing to a record. Right now the S&P is at 54.75. The Dow down 11, little change there. NASDAQ lower by 37, a decline of 0.2%. 10-year yield 4.24%, with the 2-year now at 4.71%. Gold up 0.3%, 23.25 the ounce. And West Texas Intermediate crude with an 81 handle now, 81.61, up by 1.6%. This update brought to you by Commonwealth. Join over 2,000 independent financial advisors who are taking control of their growth with advisor-centric support and future-ready technologies. Grow on your own terms with a partner dedicated to your success. Go to commonwealth.com to learn how. Fisker has filed for bankruptcy months after the electric vehicle startup stopped production of its only model, the often malfunctioning Ocean SUV. In its petition filed in Delaware, the company listed between $500 million and $1 billion of assets and between $100 million and $500 million of liabilities. Among some of the other EV makers today, Tesla shares down 1.9%, Rivian up 0.6%, Lucid up by 0.4%. Recapping, S&P little changed, up now by 1 point. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Charlie Pellet, thank you so much. We appreciate that. Alex Steele and Paul Sweeney. We're live here in our Bloomberg Interactive Brokers studio. We're streaming live on YouTube as well. So just head over to youtube.com and search for Bloomberg Podcasts. Let's turn our attention to healthcare. How about this? Japan is dealing with rising cases of a disease caused by a rare flesh-eating bacteria that can kill people within 48 hours. Health authorities have reported over 1,000 cases of streptococcal toxic syndrome. How about that as of early June? Higher than the record 941 cases reported for all of 2023. At the current rate of infection, experts fear the number of cases in Japan could reach 2,500 this year. For more on this story, we check out Amesh Adalja, senior scholar at the Center for Health Security at Johns Hopkins Bloomberg School of Public Health. Dr. Adalja, thanks so much for joining us. Can you tell us about streptococcal toxic shock? What is it?
Nice prono, by the way.
I know.
Nice
How
job.
about that? Tell us about it.
So this is Streptococcus is a bacteria that all of us have dealt with. It's the same bacteria that causes strep throat. What can happen, though, in certain individuals is it can be a much more severe infection where it can cause what we call, necrotizing or flesh-eating type of skin infections, and then also spread systemically and cause multiple different organ systems to shut down. So that's when we use the kind of term toxic shock syndrome. It's that bacteria basically disseminates toxins throughout your whole body, and it's a very serious illness with high levels of morbidity and mortality.
Doctor, is this new, or has this always been the case?
It's always been the case. What's new is that in Japan, post-pandemic, they've reported at least 2 years where they've had higher than normal cases. And trying to unravel the mystery of why that change in epidemiology occurred is what's getting headlines right now. But streptococcal toxic shock syndrome has been around forever. It's just this increase in Japan that people are interested in.
How do the medical professionals, how are they treating this?
So the mainstay is going to be antibiotics, but because it's this systemic toxin disease, we often give other drugs to modulate the immune system. And if there are elements of flesh-eating disease going on, they have to do extensive surgery to kind of cut ahead of the infection.
Oh my God, that sounds terrible. How quickly does this happen? I mean, strep can come on really quickly, and it might take you a couple days to realize that you have it. Like, what's the cycle for this?
Well, when you get into that toxic shock syndrome spiral, it's very fast. It can be dramatic. Even an hour can be a major difference in a patient. Oh, but it's important to remember that not everybody that gets a strep infection is going to get it. It's still rare. And most people who have a strep infection of their throat or of their skin, it's going to turn out to be kind of a garden variety infection. But it is important for clinicians to keep in mind that if people are getting worse, if they're not getting better, if there are more concerning systemic symptoms occurring, that they think about this. And it's also important for patients to know that as well, that if they're not getting better in the expected time, or they're taking a turn for the worse when they're already on antibiotics, that this is something where they need to seek care immediately.
Is there any reason why it would be, I guess, localized in Japan here? Anything that is unique to that part of the world?
Not particularly. I mean, we've seen increases in streptococcal infections, not necessarily toxic shock causing ones, all over the different countries. For example, the UK had a major issue with this a couple of years ago, and it may be having to do with kind of idiosyncrasies in the immunity in the population in Japan. Remember, we all came through a pandemic where there was a lot of social distancing, and many of the ordinary infections that people get every year were kind of disrupted. And there may have been different disruptions in different parts of the world and different prevalences of these infections. And now they're kind of coming back to their prior levels, and there's some catching up to do. There are people who might not have had as much immunity because they weren't exposed at a low level over the last couple of years, or they just might not have been infected. And there's a certain number that are going to be expected every year in Japan. And because you had a 2-year lull, now it's coming back to baseline levels, and that's what they're noticing. So this is kind of one of the leading hypotheses, but we don't know quite everything for sure what's going on in Japan, but that's what I think is at play.
What are the signs? You mentioned that if you're on antibiotics for strep and you don't get better, but you get worse, what are some other signs that people should be looking out for?
Well, so severe, a spreading rash that's getting severe pain if there's a rash where the infection might have been, anything involving low blood pressure, extreme fatigue, not being clear mentally, difficulty breathing, all of those kind of signs that the infection is not localized.
Yikes.
Doctor, I remember we used to talk to you all the time during the pandemic. You were very kind to share your time and, kind of educate a lot of folks on what this virus was, how doctors and health professionals were treating it, and then ultimately the vaccine and the efficacy of the vaccine. So we, again, appreciate all that time you gave us. Now that we've got that in the rearview mirror here, I know one of the themes that came out of that was just the stress on the healthcare system and the people of the healthcare system, the doctors and nurses and everybody that worked, that had to be in the front lines during those early months and that year. How are the folks, the good folks at Johns Hopkins that you deal with in the facilities, how are they doing several years on now?
Well, I think that most healthcare systems around the country have kind of come to a new normal, where there's kind of chronic burnout, there are chronic staffing issues, where people quite haven't recovered from the way that the pandemic altered hospital operations. And this is going to be one of the long tails of the pandemic. It's not something that you can just bounce back from. There wasn't a lot of resiliency built into the system. There wasn't a lot of kind of slack in it. And the pandemic ate up all that slack. And I just think that we're in a situation where a lot of people still are carrying those scars around of that time when they were overworked, where there were concerns about personal protective equipment, where hospitals were crashing. And even when you look at the economics of hospitals, we're seeing hospitals close, rural hospitals really looking at their financial viability, hospital bankruptcies. So this was something that took a major toll on the healthcare system, just like we expected and predicted it would. And this is why it's so important to incorporate healthcare preparedness, healthcare resiliency into planning for the next infectious disease emergency, whatever it might be. This can't just be something that we think about when there's a crisis, when it's in the headlines. This is something that needs to be done kind of with a long-term eye to the future, to make a sustainable way to operate hospitals and make emergency preparedness part of their core function.
How are we doing with COVID? I mean, COVID loves me. It doesn't love Paul, but it loves me. How are we doing with COVID? What are the cases like? Where are we going to get vaccinations in the fall for flu and COVID? What do you think?
Well, COVID is something that's increased over time in the last several weeks or so. But what we've seen is this virus is endemic, but it continues to mutate and spin off new variants that are able to infect us. So right now, all across the country, COVID cases are up, emergency department visits are up, but its ability to cause severe disease, its ability to crush a hospital, severely constrained because of the immunity and the other tools that we have. We will have new vaccines in the fall that are better targeted to what's circulating, and that will likely be something that's recommended to high-risk individuals that they get right alongside their flu vaccine.
All All right, Dr. Adalja, thank you so much. We appreciate that as always. Dr. Umesh Adalja, Senior Scholar at the Center for Health Security at Johns Hopkins Bloomberg School of Public Health. And again, the good folks at Johns Hopkins were so good to us, during those early days when we didn't know anything.
Nothing. I actually want to say we should get him back when there's not a crisis,
Yes.
just to learn about stuff that isn't a flesh-eating disease.
Right.
That comes from strep or COVID spreading again, just to learn about the system and what cool things are in the pipeline to be discovered and what people are treating. And I mean, everyone's living longer, right? We're letting people live longer, but then how we support them really fails. And getting that dynamic from him would be super interesting.
Yep. I went into a healthcare facility for the first time yesterday, and I can't remember how long, for some x-rays. I mean, what I was interested to see, how well it was staffed. Are there nursing shortages? Are there, technician shortages? And it seemed like it was back to normal. There were plenty of folks there. A few masks here and there from some of the healthcare professionals, but it seemed like pre-pandemic business as usual. But again, as Dr. Adalja was saying, there's some long tail issues for the industry as a whole, I guess. They were so crushed. I think about the hospitals here in New York City that were just so crushed.
You should just see the ERs are crazy. They're just overflowing. It can take days to get a bed, and yeah, it's the healthcare system is in real issues with that. Okay, we're gonna have much more coming up for you. We are gonna talk to, what are we doing? We're gonna talk to Alalu Aganga. She is U.S. Chief Investment Officer at Mercer. She's fantastic. Give us her view on the markets. And Michael Barr here for World and National News. Michael.
Thank you very much, Alex, Paul, and Charlie. President Biden is about to take sweeping action to protect undocumented migrants while trying to soften criticism about his actions at the border. We get the story from Bloomberg's Steve Potusk in Washington.
The president will announce a streamlined path to legal status for more than 500,000 immigrants. Under the new policy, spouses and children of U.S. citizens who've been in the country at least a decade will be able to apply for permanent residency without having to leave the country first. The move could be a counterweight to an order the president signed earlier this month aimed at curbing asylum claims. The president plans to roll out the policy today at an anniversary event for Deferred Action for Childhood Arrivals, the Obama-era program that protects undocumented migrants who came to the U.S. as children. In Washington, Steve Potusk, Bloomberg Radio.
An early summer heat wave is impacting tens of millions of people stretching from eastern Iowa into New England. Boston's mayor is declaring a heat emergency from now until Thursday, as temperatures in the city are expected to approach 100 degrees. In Rochester, New York, pre-K through 8th grade will be dismissed early, and all after-school activities are canceled. This parent has a student in school.
Not much you can do. The school doesn't really have air conditioning. It's not fair to the kids or staff to be in there when it's this hot. They already have off Wednesday, so it's what it is.
New York Governor Kathy Hochul has activated the State Emergency Ops Center because of the heat. Singer Justin Timberlake was arrested early today and is accused of driving while intoxicated on New York's Long Island. According to the Suffolk County District Attorney's Office, Timberlake is expected to be arraigned in Sag Harbor on the eastern end of Long Island. Boston Celtics season NBA champs. The Celtics beat the Mavericks in Game 5 last night. Global news 24 hours a day, whenever you want it with Bloomberg News Now. I'm Michael Barr. This is Bloomberg.